The markets are wagging the economy, not the other way around.
The majority of the opportunity here is really in the AI compute space.
As long as the capital markets remain open to these really massive market caps, that's the opportunity.
This is really, I think, an earnings-driven story.
It could be more choppy this summer, but we don't think that the bull market in equities is over.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, tech stocks decline, extending losses following wild swings for high-flying chip stocks as a record-breaking SpaceX IPO is reportedly 4 times oversubscribed. Investors are bracing for a hawkish Fed heading into the next read on inflation. CPI expected to hit fresh multi-year highs.
There is so much money sloshing around in capital markets. You see companies that are spending and spending, and they have the money to spend. They are raising money, and people want to give them money to spend. How much of it is bleeding into the increase in consumer prices that everyone is feeling? And that's what we're going to see today at 8:30 a.m. The potential for a north of 4% CPI year over year would put it at the highest level going back to 2023, as we see components and energy costs for everything rising.
So we haven't had a 4 handle for 3 years. Just think about that. Where was FUD funds 3 years ago? 5 handle. Right now, 375. How much work does this Fed have to do later this year?
In 2023, the Fed was hiking rates. At that point, people thought that they were on a rate hiking cycle, and they expected this to cause pain. Remember the pain speech? Well, now we're in a situation where people are still pricing in potentially, not pricing in, we're pricing in 1 rate hike by the end of this year. But the talk on Wall Street is still of the potential for a rate cut, even as you see a reacceleration of inflation. And I will tell you, down on the beaches of Rio, when I was talking to different CEOs, all I can say is everyone's talking about how demand is absolutely surging regardless of higher prices.
Okay, well, I wasn't on the beaches of Rio, but I was at the Knicks game, which in itself is basically highlighting inflation. I think it's particular to New York City, but obviously highlighting inflation. When you look at what Bloomberg Economics is talking about, they're saying that core inflation, though, which is more relative to Fed fund rates, actually they expect a subdued reading because people are paying up a lot more for things like gasoline, which is going to be part of this hot CPI print, and potentially taking away from other parts of the basket.
I'm looking for something to throw around the table. I'm going to be fired. Right, I'm just looking around. I can't find anything right now.
I came in and rearranged you to set up so that you couldn't throw anything at me this morning.
I'll find it in the commercial break. Let's turn to crude. Brent, WTI looks like this. It's pulling back. We're down by 1/10%. Such an unusual week for the energy market. It's been an unusual year. Brent crude on Monday topped at 98. It's down to 91. We've got an 88 handle on WTI, yet we've got every single reason in the last week to expect crude prices to be higher.
And we had one last night. You have the U.S. carrying out 3 waves of strikes against 20 IRGC targets. This is a retaliation of Iran downing a U.S. helicopter. I was with the president right after the Knicks game, before we went back to Washington, D.C. We asked him about this, and he said there's going to be a report that comes out Tuesday. Well, it wasn't a report. It was a response to Iran, and still oil is lower. And a lot more barrels are coming out than people had expected, whether it's ADNOC, whether it's now that Kuwait is able to get some barrels to Asia. It's just hard to really understand that all of this is going on while the strait continues to be closed.
Jeff Curry of Carlisle put out another piece essentially saying you guys are all crazy. And he said, we're robbing Peter to pay Paul. Essentially, we are flooding the market with all of this oil, whether it's from the SPR, et cetera, and then keeping demand high so that you don't get the corrective mechanism that you need to really right-size the situation, which is why he thinks we have a couple weeks left before we hit tank bottoms and all hell breaks loose. And that's essentially the reason why he is incredibly bullish on commodities.
88 as it stands won't crush demand, not stateside, that's for sure. Given the performance of this economy so far, Brent crude at 91. Coming up this hour, Steve Chevron of Federated as tech stocks retreat. Stephen Kirk of the Council on Foreign Relations as the US and Iran trade fresh strikes. And Veronica Clark of Citi suggesting rate cuts are more likely than hikes. We begin this hour with stocks extending losses following a very volatile session. Steve Chevron of Federated calling it the storm before the calm, writing, to be clear, we would see any volatility as a buying opportunity. Steve joins us now for more. Steve, good morning. Good to see you. Good morning. What do you think is behind the latest fragility, the latest wild swings for tech stocks?
Yeah, let me just say, I'm not coming from either Rio or courtside at the Knicks game. I'm fresh off the New Jersey Turnpike, where our traffic has been insane coming into the city, which is, I think, a sign of actually strong consumer demand. But look, I think there are a lot of non-fundamental factors that are going to interfere with markets and cause volatility over the summer. People need to make room in their portfolios for all the equity capital that's being raised, including SpaceX. pension funds and kind of investors that are targeting allocations, equities have run so hard over the last quarter. Fixed income has struggled so much that there's going to be a rebalancing trade, very likely, that I think will interfere with markets. Inflation. I think today's inflation report is going to mark the worst of the worst. This is going to be the biggest jump on a month-over-month. I think we kind of stabilize from here.
You think this is the peak?
Well, not necessarily the peak. You could get a report that's hotter, but the jump. I think we're going to go from 3.8 to 4.2 likely today. I think that's the biggest jump. So after this report, I think things will get bad at a less bad rate, which is usually what markets look to have an inflection point. You've got uncertainty around the midterms that'll start to come in and then you have a new Fed chair that's going to get challenged. So I think you could see volatility over the course of the summer. Our anchoring point, though, is that we still sit in what is, at worst, the middle of the biggest infrastructure build-out since the railroads, and margins that are growing at the fastest pace in my lifetime, and it's not as short as it was, you can see from the gray hairs. So we want to own that, and if we see volatility on some of these non-fundamental factors, we're likely to buy it.
Own at what price? And this is the key issue, because everybody has their hand out. Everybody wants to raise money, and the sums of money are getting bigger and bigger to pay for higher and higher cost items because inflation is going up as quickly as people can raise money to pay it.
I think prices are up. I don't think inflation is in place. And I think that that's a key element. I don't think what we have is a self-reinforcing upward cycle in prices. And the reason I don't think we have that is we don't see it in wage gains, which are still pretty modest at 3.5%. And what you're seeing is pockets of weakness in parts of the consumer basket that's offsetting the strength that you see in energy commodities. What we have is a Strait of Hormuz that's closed. And if energy is not flowing, prices are going to be higher. But what we don't have that we had in kind of 22 and 23 was just more and more money getting pumped into the system, whether it was through government stimulus or rates that are zero. And so I think what you're going to see is, on a year-over-year basis, the biggest jump, this kind of 4% number. And then I think we'll see a string of 4% numbers. But then all of a sudden, when you get to the back half of the year, you've lapped the tariffs. Even if energy prices stay exactly where they are, once you get to next March, energy inflation is zero at that point, right? So, and I think what we're likely to see is energy prices that ease some, not necessarily go back to where they were pre-conflict, but ease some. So I think we have higher prices. I think it's hurting some people, but I don't think that this is that self-reinforcing inflation cycle.
I would take issue with one thing, and this is something that I was hearing from a lot of...
I would expect that, Lisa. That's kind of what we do.
And by the way,
yeah,
you're off to a fantastic vacation next week, so don't exactly cry me a river about our experiences.
Fair enough.
Let's not go there. But I will say, one thing that, as I was talking to different CEOs, they're talking about how much money they have and that their margins have been increasing, not decreasing. And you said that fiscal isn't necessarily coming in the same way that it did during the pandemic. Maybe so, but you're getting tax breaks that are giving them a lot of cash. At what point will companies have to raise wages in a commensurate way because they have so much money, they need to build their business, they are all investing in CapEx? I mean, why isn't that a likely outcome?
So let's talk about the margins first. And this is really important because in a high inflation environment, usually stocks don't do as well as they do in a low inflationary environment, unless earnings are growing above trend. And they do particularly well when margins are growing. So what the history shows is that stocks can do as well in a high inflation environment as they do in a low inflation environment if margins are growing. And that's why you see the stock market as resilient as it is. As it relates to wages, wages are growing. They're growing at about 3.5%. And that's about where you want it, right? When it gets over 4, that generally becomes a self-sustaining kind of problem. That's 2022. 3.5%. With inflation kind of around 3, let's say that's been the average, that's real wage growth. And again, that's very different than what we were seeing with the inflation of 22, 23, when we had a record period of negative real wage growth for the consumer. So the consumer here, and I think this is the biggest contrarian call, we all know how difficult the consumer's been, how K-shaped it's been. But look at the bottom part of the K. All of a sudden, instead of adding 10,000 jobs a month, we're adding 180,000 jobs a month. And the biggest decline in the unemployment rate so far this year is folks, some college degree, high school diploma, less than a high school diploma. I think that bottom part of the K is set to do a little bit better than what we've seen over the last year.
Steve, what do you think the Fed does next week with all of this?
I think you're going to see the Fed likely on hold. What I expect to hear from Warsh is how he's going to look at things. He's not going to come out and say, hey, we're not hiking or we're hiking. I think he's going to maybe reiterate that he's going to look at trimmed mean measures of inflation. I think he's going to lay out a framework or a series of breadcrumbs that will communicate to the market that this Fed's not going to hike. I mean, I really think that
not going to hike this year.
Because here's why. What is it going to do? the parts of the economy that are rate sensitive have already been in a recession. That's been what we've talked about around this table. So are we going to punish the low-end consumer more? Are we going to punish small businesses more? Because you can raise rates all you want. It's not lowering a chip price. It's not lowering the price of a gas turbine because the buyers don't need debt and they're price insensitive. So what you don't want to do is hike rates and destroy those interest rate sensitive parts of the market so that if AI CapEx slows down, you find yourself in a negative cycle. So I think this Fed will understand that. I hope that they'll understand that. I think it'd be a real policy error to get too aggressive on it.
So you're looking for something dovish relative to more hawkish expectations?
I'm expecting him to, drop some breadcrumbs. And the breadcrumbs would be things like, I'm going to focus on trim mean inflation.
I or we?
What's that?
I'm going to or we're going to?
That's the question, right? Because he does have the hardest management role, I think, of any Fed chair in a while, particularly with his predecessor sitting there, apparently keeping a low profile, but then giving speeches that aren't so low profile. So we're gonna see. We've always assumed that even though it's a committee, the Fed chair sets the direction. I would expect that Warsh, being well prepared and very interested in this job for a long time, will be able to navigate that. We will see if it really is a committee. Strap in.
He's had 10 years to think about it, that's for sure.
He's very well prepared for this job.
Without a doubt. Steve, you wear the New Jersey sun well. It's good to see you.
So much.
Thank you, sir. Steve Chevron of Federated. Who needs a vacation? Huh? Who needs Rio?
Is that what you said? Okay, this is John's take. This is John's take. After I went to Rio, Annmarie went to the next game. John's like, who needs to go on vacation?
He looks so tan and rested already. Right?
Yeah, if you spend a lot of time on the soccer fields.
It's that Italian blood. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Good morning. U.S. forces carrying out fresh strikes against Iran, targeting air defense and surveillance sites near the Strait of Hormuz yesterday afternoon. The attacks coming after President Trump blamed Tehran for shooting down an American military helicopter on Monday. Bank of Japan Governor Kazuo Ueda has been hospitalized and is set to miss next week's monetary policy meeting. The BOJ writing in a statement, quote, his hospital stay is expected to last approximately 2 weeks. The deputy governor will serve as acting chair for the meeting. TSMC reporting a 30% rise in its monthly sales, the increase reflecting continued strength in demand spurred by a global rush to build AI infrastructure. Asia's largest company has become an essential global AI player by making cutting-edge semiconductors for companies including NVIDIA and AMD. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thank you for the update. More from Vonnie later this hour. Up next on the programme, a ceasefire on the brink.
I would say the ceasefire is on massive life support. In that part of the world, ceasefires when you're shooting in a more moderate manner. We're going to win one way or the other. It's going to be militarily or on paper.
Up next, we'll catch up with Stephen Kirk of the Council on Foreign Relations. Live from New York City this morning. Good morning. Inflation data later this morning. CPI 8:30 Eastern Time ahead of PPI later on this week. The guesses, the estimates in our survey look like this. The median for year-over-year CPI could have a 4 handle for the first time in 3 years. The estimate 4.2%. That's up from 3.8. Expecting core to hold steady just below 3%. Heading into the Fed meeting a week today. The first meeting for Kevin Warsh, the new Fed chair. Into that really volatile price action for equity markets stateside. Equity futures this morning declining by 0.8%. The losses continue on the Nasdaq, down by 1.2% after bouncing on Monday, taking it all back on Tuesday and then adding to losses this morning. That's the stock picture. Here's the bond market. 2s, 10s, 30s look like this. 2s at 413. Yields creeping higher again by a single basis point. 10s around 453 off the back of some jitters in the commodity market. WTI and Brent shaping up as follows, even with the tension in the Middle East. Look at this. 88 handle on WTI, 91 on Brent, and unchanged on the session. When I saw the headline drop yesterday, I was like, oh, here we go. Crude might wake up.
Yeah.
Crude didn't wake up at all.
It woke up for a hot second. It was sort of up for 4%, and then it went right back down. And ultimately, people are looking through this and saying that the fact that the ceasefire is being preserved in any capacity whatsoever, with them lobbing missiles at each other and blowing things up, seems a little bit ridiculous. And that gives you a sense of what the desire here is, which is to stop the kinetic conflict and to get the Strait of Hormuz back open.
Crude rolled over and went back to sleep. Seems to be the last 24 hours. Under surveillance this morning, a ceasefire on the brink.
I would say the ceasefire is on massive life support. If there's no ceasefire, you're not going to have to know. You're just going to have to look at one big glow coming out of Iran. In that part of the world, ceasefire is when you're shooting in a more moderate manner. There's a reason for everything. And we hit them pretty hard. We're going to win one way or the other. It's going to be militarily or on paper.
So here's the latest this morning. The US and Iran exchanging fresh strikes after Tehran downed a US Apache helicopter, further straining the fragile ceasefire. Bloomberg's Tyler Kendall joins us for the latest. Good morning, Tyler.
Hey, John, good morning. Well, this underscores just how high the tensions are running, as this week marks the worst flare-up in fighting since the ceasefire was announced. CENTCOM says that the U.S. response yesterday was proportionate and done in self-defense, with the U.S. striking Iranian military targets, including radar sites, command and control stations, and air defense systems for Iran near the Strait of Hormuz. It comes after yesterday we heard from Iran's foreign minister in a post on X, who didn't deny that Iranian forces were involved in the downing of this American military helicopter, but seemed to suggest that perhaps the incident was unintentional. In the wake of the U.S.'s strikes, we heard from Iranian state media overnight confirming that the IRGC tried to target at least 4 American military targets, including the U.S.'s main naval base in Bahrain. Now, President Trump was asked over the weekend and pressed on it really in this interview with NBC News on what his red lines would be in order to end the ceasefire. He said if Americans were killed or if he feels that a deal could not be reached, because at this point, despite all the escalation, the White House still says that diplomacy is a viable option. And a person familiar with the matter confirms to Bloomberg News that the negotiations are ongoing this week, with Pakistan as the main mediator. In fact, John, we got some new reporting from the New York Times yesterday that put a little bit more of a finer point on where these talks may be headed, reporting that the two sides appear to be closing in on 4 main issues related to Iran's nuclear program. That includes the potential for a lengthy moratorium on uranium enrichment, which the Times is reporting the U.S. feels could land at 15 years.
We'll see. Tyler Kendall with the latest down in Washington. Tyler, thank you. To build on that, Stephen Kirk of the Council on Foreign Relations writes the following: markets seem to be waking up to the fact that the Strait of Hormuz is not opening anytime soon. Stephen joins us now for more. Steve, welcome back to the show. The president looks committed to finding the off-ramp. The Iranians look committed to testing his patience. And I just wonder, Stephen, how long we can hold on to this ceasefire.
Yeah, the president has indicated over and over again that he's unwilling to escalate. The CENTCOM's response to the downing of the helicopter yesterday was essentially a pinprick. We're talking about radar sites, a number of facilities along the Strait of Hormuz, which have been hit before. The Iranians just move these things back underground and then bring them back up when they are going to use them. Again, this is not a return to combat. And the president has indicated over and over again to the Iranians that he's not interested in that. That has given them license to actually make more demands and be more aggressive in the region. They're now trying to fold Israel and Lebanon firmly into any agreement so that they have some sort of control over Israeli security.
Stephen, what do you think the sticking points are right now in terms of the discussions between Washington and Iran?
I think those sticking points remain what they have been. The question of Iran's uranium enrichment. If the New York Times is right, we're basically going back to where we were with the JCPOA, President Obama's agreement with the Iranians over a moratorium on the nuclear program back in 2015. Then, of course, there is this issue of the Strait of Hormuz. That helicopter that was shot down was patrolling the strait while the Iranians were shooting drones at commercial shipping that is using a lane of the strait that the U.S. is assisting with. The Iranians have no intention of opening this strait without having some sort of control over it. And those are what the sticking points were on April 8th, and they're the sticking points today on June 10th.
But the goalposts continue to change. Earlier on in the conflict, the president said a 20-year ban would be insufficient. Now they're going to settle for 15?
He's clearly looking for that off-ramp. He's frustrated. He said last week that he was bored with these negotiations. We could be approaching a situation where the president actually capitulates. Maybe it's not 20 years, 15 years, 22 years, whatever it is. It seems to me he's looking for something that he can sell, that he can get out. The Iranians, however, haven't been willing to play ball and have remained steadfast in their demands that they have a right to enrich uranium and that they want some control over the Strait of Hormuz.
Stephen, you wrote that the markets seem to be waking up to the fact that the Strait of Hormuz isn't reopening anytime soon. Is that true? Do you really think that this market is waking up to that reality?
Well, you all would know better than I would, but it seems to me that over the course of the last few days, the market slides indicate that people are coming around to the fact that there is a major choke point in the global economy and that it's harder and harder for energy to come out. As far as the oil markets go, there is a difference between the market and the molecules, and we're starting to see shorter inventories in the oil market.
How has this complicated the relationship of some of the Gulf nations with the United States in terms of what they're looking for and how much this potentially impedes some of their ambitions to become global business centers?
Yeah, I think there's two things that are of great concern to our Gulf partners. One is that the president grows frustrated, declares victory, and goes home and leaves them with a mess that's not of their own making and something that they didn't want. It is a major concern. I've heard from Saudis, I've heard from Emiratis, I've heard from others that this is something that the leadership and others are very concerned about. And then there is the question of whether the Gulf model of development can continue as it had. The idea being that this is a safe, stable, secure place in which to invest, to establish data centers. Right now, though all of those things are questionable, although the market, once again, people seem to continue to believe that these places are, over the long term, places that can be critical parts of the global economy.
Steve, there's a whole industry dedicated to criticising the president. This is not actually a criticism, it's just an observation. This is very off-brand for the president when it comes to geopolitics. This whole adventure has been very off-brand. And I would suggest even the last week has been very off-brand. This is an administration that has claimed to pursue peace through strength and criticised the previous administration for not showing American military might and securing peace through those means. And yet, Steve, this is looking more and more like what we saw under Biden, particularly the last week, letting these kind of things go. Stephen, what's behind the change?
Yeah, this is a rather extraordinary change for the president. He was in the Gulf just a year ago, and he said things that are diametrically opposed to what he, in fact, is doing. Just the investment in the region, the military investment, all of that is counter to everything that he said when he was in Riyadh last May. And then now, where he is willing to let things go, it is one thing for the president to suggest, well, you know, the Iranians attacking are below the threshold of a ceasefire. But when it comes to the Strait of Hormuz, on a daily basis, the Iranians are trying to prevent commercial shipping from going through the lane in which the United States is committed to assist commercial shipping traversing that waterway. The fact that we haven't responded to that does not suggest peace through strength.
Stephen Cook, it's good to see you, sir. Thank you. Stephen Cook there, the Council on Foreign Relations. It's an observation I think we're all paying attention to, the shift that we're witnessing under this president.
The U.S. right now is very much so on the defensive. So they're responding to attacks. They're not on the offensive and making it clear that we will not be tested yet again, because we continue to see these skirmishes happen between Iranian forces, the IRGC, and the U.S., and especially our allies like Kuwait and Bahrain that have been really under intense fire and pressure from the regime.
Crude just about unchanged off the back of this mess at the moment, which is unbelievable. The price action this morning, the fireworks in equities, tech stocks declining once again. We're negative by 0.8% on the S&P 500 and down a whole lot more on the Nasdaq. On the Nasdaq, negative 1.2%. Up next on the program, we'll catch up with Thoma Bravo co-founder Orlando Bravo, declaring an end to software AI disruption fears. Plus, Yahira has your morning movers. Supermicro joining the race to raise cash for AI spending. Check out that move in the pre-market. The stock is down 10%. This equity market is beginning to look increasingly fragile, particularly in the chip sector over the past few sessions. Equities declining once again, down by 0.75% on the S&P 500. At the highs yesterday, we'd bounced back big time, up 1%. Then we were down 2% at the lows, down marginally at the close. On the Nasdaq, we saw some wild swings, down 4% at one point. The Nasdaq this morning down by 1.2%. And if you want some really, really wild swings, check out the Philadelphia Semiconductor Index. That particular index was down 8.6% at the lows, and at the highs was up 2.8%. So 10 percentage point range. And to your point, Bram, I know every single morning you're looking at the same thing I'm looking at, which is South Korea and the Kospi, which is pretty wild in and of itself.
I mean, some of these losses have just been shocking, right? We saw a more than 8% move to get down on just one day. You see this incredible volatility, and you start wondering how much are these leveraged funds that are getting whipsawed by sentiment and trading around the margins. What's fascinating is, yes, you're seeing this fragility and this increased volatility, but you're seeing a broadening out with actual gains for 3/4 of the stocks, and you're seeing less bond market volatility. So there's something going on, and no one can really put their finger on what it is that's creating this volatility in these names.
Well, Steve Chivarone touched on this a little bit when it comes to this massive amount of tech equity issuance. Potentially, he says this could be the case for selling pressure when it comes to other areas in the market to make sure that they can loosen up that capital to get in. Friday is going to be a massive deal for this equity market.
There is a record-breaking mega IPO on the horizon, and in between that, some equity offerings from some single names as well. So let's get into that. Let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. Exactly. We start with that one. We are seeing Supermicro down 10% in the pre-market as it becomes the latest company to join the party to raise capital, announcing a $7 billion equity raise. Sales of its AI servers have surged, but that just means it needs more money and more cash to fulfill some $39 billion in orders. This follows a period of significant cash burn for the company as Supermicro has to spend heavily upfront for chips and other components, which of course we know have gotten pricier. Speaking of chips, we are seeing some signs on demand from TSMC, reporting a 30% jump in sales for the month of May. That is, of course, strong, but a bit weaker than Wall Street expecting. Also, hanging over the stock is sentiment in the chip sector is weaker again today, with names like Intel, AMD, NVIDIA, all lower, coming after the Philadelphia Semiconductor Index, as you mentioned, ending the day down 7% in yesterday's session. And we get the next big test on the AI trade later today when Oracle reports shares are falling into that, down some 2.7%. And looking through analyst notes, the big question will be how quickly Oracle is building data centers and converting AI bookings into actual revenue at a time when we know demand is already strong. So all about execution here.
Yahira, thank you. Thank you for the update. More from Yahira later on in the program. On our radar this morning, SpaceX drawing tremendous investor demand ahead of its mega IPO. Reuters reporting the offering is approaching 4 times oversubscribed with over $250 billion in orders. Elsewhere, TSMC shares pulling back. The chip giant reporting a sharp rise in monthly revenue. Asia's largest company seeing a 30% rise in sales as AI demand shows no signs of slowing. And yet here we are, down by close to 3%. And finally, check this one out. Apollo and Blackstone finalizing a $35 billion finance package for Anthropic to expand its AI infrastructure. The deal will fund Google's custom chips for Anthropic to lease, with Broadcom backstopping payments on the largest senior portions of the debt.
Things are getting creative in terms of some of the structures and what pieces people are picking off and how they're backstopping some of their investments. The numbers are getting bigger and bigger, the players having to deploy things. When you talk to someone like from Apollo or Blackstone, they talk about trying to get security, having a short duration piece, maybe 5 years, et cetera. The numbers are just mind-boggling, though. I mean, you start to look at some of the circular financing. You start wondering how much everybody is just hinging on each other's success for everybody to go up. You're seeing that with respect to Google and what they're doing with Anthropic. You're seeing this across the board. Everyone is just becoming completely intertwined and hinged on this being a successful story.
That's the obvious criticism here, that this looks circular, that it's off-balance sheet debt with an IG rating. Thank you, Broadcom. And if you're not familiar with the structure of this particular deal, there are 3 tranches. The riskier piece of this, you're compensated with extra yield, but Anthropic's on the hook for everything. The more senior portions of this debt, you get the residual value of the chips. If that's not enough, Broadcom steps in, hence the IG rating on the more senior level of the debt. Does it sound risky? Does it sound creative? It sounds creative, yes, but if you think back to, say, the car business of the last 20, 50 years or whatever, take a GM, a Ford, financing the purchases of their vehicles, so long as it's a small part of the business and not a large chunk of the business, and the argument I think we'd hear this morning is that for Broadcom, this is only a small part of the business. More broadly, though, Bram, I think you're on exactly the right point. We are seeing very creative ways to raise more and more capital. And not every company has very flexible capital structures and the ability to do an alphabet and say, you know what, I'll go to Canada, I'll go to Switzerland, I'll go to the UK, and I'll borrow $40 billion, $60 billion in over 4 months. Not everybody can do that. And when you see the equity piece of this, I actually find the story that Yahara talked about just moments ago. Supermicro comes out looking to raise equity, stock gets hammered. Meta talks about raising equity, stock gets hammered, just a report of that in the Financial Times. They're the things I'm focused on. Is that pushback going to start to build to the point that these companies have to reconsider their plans?
How much are these companies increasing their risk? Essentially, if they're taking down the riskiest part, if they're taking down the leverage, if you aren't necessarily accounting for the cost of all of the purchases of the chips until those chips are deployed, that is a depreciating asset over time. How do you calculate the risk that's building in some of these companies with all of this creative financing? That, I think, is the increasing difficulty. And the fact that they just keep needing to raise more and more money. I mean, really just a handful of names needing to raise more than $600 billion of debt this year gives you a sense of what we're talking about here.
We're focused on these IPOs on the horizon. I get it. They're all the headlines. I understand that. But the amount of money being raised on the debt, being raised on the debt and equity side just over the last 12 months has been phenomenal.
And it's going to pay for prices that keep going up. This is the key issue, right? Prices go up, so their capex has to go up. And then the prices go up further, and then their capex goes further. And at what point are you paying for the inflation that you're seeing in all of these different components?
Elsewhere, private market deal makers gathering at the annual Super Return Conference over in Germany. Danny Berger focused on many of these issues. She joins us now from Berlin. Hey, Danny.
Hey, John, that's correct. And there's one issue I want to focus in on particular, and it is the state of software and private equity. And we have the leading voice to talk about that. It is Orlando Bravo, the co-founder of Thoma Bravo. Orlando, always a pleasure to see you here.
Danny, so good to see you. This is our yearly tradition.
It is our yearly. I would be gutted if we didn't meet, same place, same time, every single year.
One of the reasons I come here is to do this.
Okay, hopefully among the top. And I know this year you have a particular message. I remember earlier this year you were talking at Sohn saying the SaaS apocalypse, the worst is over. Does it go further in your mind, just the worst being over? But is this thing over, Orlando? Where are we in the world of the SaaS apocalypse?
Danny, SaaS apocalypse, for whatever term, and that's a terrible term, by the way. I really don't like that term. It is finished. No more. And it's pretty simple. You know, people are realizing that these are unbelievable companies. And you look at the numbers coming out, even after the first quarter. And secondly, and more importantly, people are realizing that SaaS companies just don't stay still. They're not static. They evolve with infrastructure. They evolve with opportunity. And SaaS and agentic are going to merge very, very, very quickly. And these companies are the future of agents in the enterprise. And the market is realizing that as well.
So the freak out is over, essentially. Is that what you're saying? In private markets, is this stuff starting to be realized, your portfolio, maybe some of your peers, at the valuations that you think they should have? Or is there still some frozen assets, some stickiness that has yet to come unglued?
In private equity, the environment is pretty stuck right now. Now, I do think that private equity is the voice of reason in a lot of this, because it makes sense that deal activity is a lot slower. Because if you're going to buy a technology company or a software company, a solution provider to the enterprise, now you really want to see that they're making a lot of progress around their AI offerings. Enough time has passed that you should see that in the business, because that's where the whole world is going to evolve to. So why not wait a little longer before you pull the trigger and have a little bit more clarity? That makes sense to me.
It doesn't sound like the worst is over, Orlando. It seems like there's still things that need to be tested and figured out. So what is the aspect? Is it just, are you saying our companies are healthy, or is there something else that the worst of the freak out is truly over?
Well, the freak out really happened in the public markets.
True.
Right? And you've seen since April, software stocks have rebounded really, really strongly. But the other thing that you notice, and this is really about public investor sentiment, is that whenever there's an announcement about one of the great LLMs coming out with an amazing model like today, the whole software industry doesn't collapse or react to it. A big place where you saw the freak out, as you called it, be completely over, is where we invest 50% of our dollars in cyber. This is a huge tailwind to cyber. And that's one of the sectors that has rebounded really strongly over the past month.
What about in lending? What are conversations with your lenders like? I remember we had a conversation saying the cost of capital has gotten a little bit higher because of concerns. Has that come back down, or are there still difficult conversations to be had?
Lending is very difficult because, and I'm going to be completely upfront about this, there are many large asset managers that need to raise so much money monthly, and from retail. And it's not the most popular thing right now to pile that money into software. So it is a much tighter environment. Now, on the buy side, of course, that hurts you with financing, but it means you pay a lot less. And funds like ours, we do a lot better in down markets than in up markets because we're value investors. So we're really enjoying this opportunity. But once again, we're treading carefully because we want to buy companies that are part of the future, not companies that are stuck in the past.
By the way, Thoma Bravo, more than most companies, has been very successful with exits. You've also had some really successful IPOs, too. We're going to get SpaceX this week. We learned that OpenAI is going to be coming to market. Anthropic also filed for an IPO. Is this good or bad for the IPO environment and prospective exits? Because, for one thing, it starts the capital flowing, but there's also this question, is it all just being funneled? Are these just black holes of capital if you're competing for the same institutional money?
Exactly. Both points are so true. I was talking to my partner, Seth Borough, about this. He's in charge of a lot of companies along with Holden Spate that look like they're great IPO candidates in the $25 billion, $30 billion valuation range based on about $1 billion of free cash flow and their growth rates. And both of them told me last year, we won't be able to do anything this year because all the attention and all the time, let alone the dollars, are going to be focused on these massive, historic IPOs. So these smaller caps, which we are now, I guess are much more difficult to get the attention in the short term. Now, medium term, I really hope they do well because they're really important moments for capital markets and their depth. And if they do well, you'll get more confidence in the IPO market.
Well, what is a typical period for that? I know SpaceX is, we don't really have a historical corollary because it's just so large in size. But what would be your estimation of when you can enter back into the IPO market after these come in?
Hopefully 9 months, a year after. Now, that's a guess, right? So many things are up in the air. What happens with interest rates? What happens with valuations? Is there a slowdown in the infrastructure build? There's so many questions, right? It's a wild investing environment. People are saying a lot of strange things in investing right now. And the toughest thing for people that have a core competency in something is to stay the course. And of course, once again, you have to be part of the future, but you have to stick with what you know really well.
Well, I remember you and I last year had this discussion that this industry had lost its way. Do you think people have had that come to Jesus moment? Have they kind of come around, or are there still lessons to be learned, do you think?
They're having it now. Look, if you see some of the software troubled credits, which there are, it's out there. It's not yet a product of AI having impacted those companies or those companies failing to transition to the new platform, which, by the way, is the biggest opportunity in the software industry. It really, really, really is. It's an issue of how those companies were run. People thought 10 years ago, after they saw all this money being made in private equity and software, that it was really easy. I buy subscription revenue, 90% gross margin, I cut some cost, and I'm good to go. They forgot to innovate, and they forgot to invest in R&D, and they forgot the domain knowledge of existing management by replacing them. And that's coming back to create some flatness in the environment, which is very difficult for those businesses.
By the way, any huge calls of how many people are going to be losing their jobs?
Look at this conference. As you know, I'm an optimist, but what we're seeing in development, the great use case for AI is we're hiring a lot more developers.
Orlando, so great to see you. Thank you so much for joining. Always a pleasure.
Thank you.
John, that's Orlando Bravo of Thoma Bravo. Interesting to hear. Again, he didn't like the term SaaSpocalypse ever, but it is dead. But also that IPO window might need to wait a little bit before you can bring companies public, just given the gravity pull of SpaceX.
Interesting. Danny, nice work this morning. Enjoyed the conversation. Thank you. Let's get you an update on news worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. US CPI data due out at 8:30 a.m. this morning. Economists expecting headline inflation to touch 4.2%, the highest since May of 2023. The core CPI forecast is for it to come in at 2.9%, up 0.1% from a year ago. Investors are raising rate hike bets ahead of today's CPI print and next week's FOMC meeting. A Florida trading company says it's in advanced talks to send Cuba the biggest cargo of U.S. fuel since the Eisenhower administration. Vanguard Energy is gearing up to export 250,000 barrels of diesel and gasoline. Anthropic is releasing a Mythos-like model without cyber capabilities. Fable 5 will have guardrails that prevent it from responding to certain types of queries, including those related to cybersecurity and to biology. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for the update. Up next on the programme, the Fed rate hike debate.
Inflation expectations, a tight labour market, both are signalling cause for concern. We need to see the Fed remove the easing bias and ultimately remove the insurance cut from last year. That leads us to 3 hikes starting in December.
That's the case to hike. Up next, the case to cut. Not once, but a few times. Veronica Clark of Citi joins us next. Equities declining this morning by 0.7% on the S&P 500, down by 1 percentage point on the Nasdaq, a pullback on the Russell by 0.7%. Yesterday was interesting. The bond market actually provided an offset. 2s, 10s and 30s, a 4 basis point drop across the curve. Yields this morning up by not even a single basis point. 2s back to 412. 10s at 452. Heading into CPI later this morning. As Lisa said earlier this morning, we're looking for a 4 handle on headline inflation.
People are going to be looking at the underlying components. What's driving this? Is it being driven purely by energy costs? The core CPI is going to be really key in focus. How much not only is being driven by energy, but also AI spending? And can you strip that all out and saying the consumer still isn't necessarily increasing their spending that much? Or do you have to take a look at some of the inflationary inputs that were really in play when the Fed was hiking rates?
And then a week today, Kevin Warsh at the Federal Reserve. Under surveillance this morning, the Fed rate hike debate.
I would think of the break-even market as a faulty fire alarm. You rely on it to get that signal, but you're not getting it. Inflation expectations, a tight labour market, both are signaling cause for concern. We need to see the Fed remove the easing bias and ultimately remove the insurance cut from last year. That leads us to 3 hikes starting in December.
So here's the latest this morning. Investors raising rate hike bets ahead of today's CPI print and next week's FOMC meeting. Veronica Clark of Citi suggesting cuts are more likely than hikes, writing, in our base case, the Fed cuts rates 75 basis points this year, with 25 basis point cuts in September, in October and December. Veronica joins us now for more. Veronica, good morning.
Good morning.
Explain yourself.
I know.
4% inflation later this morning. Potentially. We'll see what we get. And you've got 3 rate cuts for this year.
A lot has to change, of course, right? The most important thing I think that will change is that we will see weaker labor market data over the summer. Certainly don't see that yet in payrolls, but there's a lot of conflicting evidence. You know, we've had such strong payroll job growth, but the unemployment rate has stayed at 4.3%. We haven't seen wages pick up. Hiring plans have come back down again. Those tend to lead payrolls. Now initial jobless claims are rising. So I think we will see weaker employment data this summer. And then, yeah, you need to see some favorable details of inflation. And there's probably going to be more of this debate among Fed officials of what's the right inflation measure to look at. Core PCE is incredibly strong, but it seems like the outlier. And I think we'll see some better details even in CPI this morning.
Let's stay on the labour market. You mentioned that. That's the basis for this call. We had weakness in the labour market last summer, weakness in the labour market the summer before. Feels like we've got momentum this time going into this summer.
Yeah, payrolls have been stronger, but I'm really cautious that the payroll data have just gotten really volatile this last year. We've had some months now where they're consistently stronger. But what I think might happen is that when we get such a big shift in immigration patterns, and I've seen this in Canada also, is that you can just create this shift in employment patterns throughout the year. And maybe that's why you haven't seen such a retightening in the household survey, the unemployment rate, that's stayed stable. And that stayed stable while immigration has slowed, and that's stable ahead of the summer hiring season. When you do get students looking for work, new graduates entering the labor force, it's that summer season when you're supposed to hire a lot of people and then you're not. That's when we see the unemployment rate rise. So.
At the same time, we did see the employment number rise quite a bit. And a lot of investors say maybe this data is kind of messy. So look at what the companies are saying. And what the companies are saying is robust demand, robust growth, robust profits.
Yeah.
At what point Does that make you a little nervous about your thesis?
Yeah, they're also saying, though, that we're not hiring people. So we got the full details of the NFIB Small Business Survey yesterday. We got the jobs details of that last week. Hiring plans in that NFIB survey do tend to be a good leading indicator for payrolls, and they broke through the lows in May. So they're the lowest that we've seen really since the pandemic. So yeah, people are still spending, but there's been this pattern for a couple years that you can have this really low hiring, weaker labor market, enough to keep the unemployment rate gradually rising, but consumption is still strong.
Can the Fed cut rates if it ends up spurring capital markets even further at a time when they are incredibly hot and people are raising tens, hundreds of billions of dollars? I mean, I can't even get my head around some of these numbers, and are able to do so because they are wide open and increasing inflation in certain pockets.
Yeah, that is the best argument for maybe why you shouldn't be cutting, because the inflation that you see really is coming from, maybe the business sector, right? It's that AI-related inflation. For PCE inflation, it's also equities that are rising, those financial services prices. PCE in May probably looks pretty strong. But if you're considering what, traditional, drivers of inflation, tight labor markets, housing, what is higher rates going to do to home prices that are already flat on an annual basis, and wages that have already slowed back to pre-pandemic, and it's not a source of inflation.
A lot of the Fed speak has focused on individuals saying it's time to go back to neutral. Who do you think represents your position right now at the Fed?
I think the Fed official that I would pay most attention to, that maybe sounds the most, cautious like I am on the labor market, is Mary Daly. And yeah, most Fed officials, of course, are going to be fine leaving rates as they are now. We're going to see, guidance removed and everything next week. But if there were to be any signs of the labor market loosening again, I think someone like Mary Daly would be an early indicator of that.
Bank of America thinks it's messy as well right now in the labor market, but they don't think it's MESSY. They think it's MESSI. They think it's the World Cup.
Right.
Do you think there's a World Cup impact here?
People started to cite that right after we got the data. We had the strength in leisure hospitality, a big interesting increase in local government employment. Maybe there's some security or something related there. We'll get the state level data in a couple weeks. It does not align perfectly with the national data, but probably gets more important as people try to pick out, as the hiring in these states that are hosting the World Cup.
Veronica, good to see you. Looking forward to that data as well. Veronica Clark there of Citi. Heard that explanation repeatedly over the weekend to really support that massive surprise we saw on payrolls.
I asked Scott Kirby about this from United Airlines, and he said it's an infinitesimal point. However, on my plane back from Brazil, the number of people wearing Brazilian jerseys, first of all, that's just sort of the uniform you have to wear in Brazil, is that sort of
that was the Bolsonaro
yellow
uniform at one point, wasn't it?
And green. I mean,
it took on a very nationalist.
It was very political at the same time. Either it was political or everybody was going to the World Cup because nobody could speak English and everybody was wearing that jersey.
This has nothing to do with the economy. My favorite thing about the Brazilian team, they blessed the plane on the tarmac. I think you sent me this video.
They baptized it.
Yes. Can we get a Jesuit or something down at MSG today before Game 4?
Big game a little bit later. You heading over?
No. I mean, maybe.
Is the president going back?
A sports reporter came out and said the president will not be attending Game 4 after rumors. So I guess there was an inquiry sent from the White House, potentially, that I'm reading into this, about him going back. I think he wants to be there for a win. He doesn't want to be there for a loss. He stayed for the whole game.
Bramo's not interested.
Putting aside President Trump.
Tell us what you really think.
To have somebody shut down all the streets, all the watch parties.
But they're doing it again tonight.
All the joy
so what's the
that typically comes
I'm totally
from all
with
of
you.
this is you have to get there 4 hours in advance. Come on, this is New York.
They shut down the joy. How dare they?
I mean, it's not even about who it is.
I get you. I understand. Up next on the programme, could tell that Bramo was frustrated. Jim Bianco of Bianco Research.
Traffic.
Laura Galante of WestExec Advisors. Henry McVey of KKR. Tony Rodriguez of Nuveen, the second hour of Bloomberg Surveillance, just around the corner.
There's nothing in the data that leads us to believe that inflation is slowing down on a steadier basis.
All the inflation we're really seeing is supply driven.
The Fed is succeeding on the job side of the mandate, but not succeeding on the inflation side.
There's a lot of inflation in the pipeline, which is going to affect the actual CPI numbers.
I think it's going to be very important, and I think it's going to be grim.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Jim Bianco coming in hot this morning, talking about everything but financial markets.
It's the stuff people care about this morning.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. And your price action, financial markets, look like this. Equity futures on the S&P, negative 0.6 after wild swings in the last 24 hours. On the Nasdaq, down by 1 full percentage point. In the bond market, things settling down just a bit. Heading into CPI, 2s at 412, 10s at 453. And in commodities, energy not doing much. It's got every reason to rally. And it isn't. 91 on Brent, WTI at 87. Heading into this at 8:30 Eastern Time. Just around the corner, 90 minutes away, CPI in America.
Yeah, we're going to get a read that potentially is the hottest going back to 2023 in 3 years, north of 4%. And a lot of people are going to look beneath the headline. And the bulls, the hawks on the Fed camp are going to be talking about just the headline number and the reacceleration, how this is problematic, and it's coming from core as well. And the people who are dovish are going to say, look, it's all energy, it's all AI spend. And when you take a look at the other metrics, like we were just hearing from Veronica Clark, it isn't that inflationary. Trimmed bean, it's below 3%. Who's going to win out? Ultimately, this market is looking at the hawks.
There's going to be something for everyone on the Federal Reserve when it comes to this inflation print, whether you look at headline or core. But for this White House, owning a four handle on inflation is not a good look going into peak driving season and obviously the midterm elections.
So you've heard the case to cut from Veronica Clark over at Citi. Unemployment, the labour market, she thinks things will weaken through the summer. Don't see that right now. You've heard the case to hike from BNP Paribas. And BNP's point is something I've heard also from Matt Lazzetti over at Deutsche Bank. Framing matters here. Do you think we need to hike? It's one way of asking a question. Do you think we need to take back the cuts of last year is another way of asking the same question. And that's the push that I'm hearing more recently over the last week.
Did we take out too much insurance, given the fact that this market was running a lot hotter, this economy was running a lot hotter than people previously expected? And I would take that a step further and say right now, the momentum that you're seeing in capital markets, despite rates where they are, gives you a sense that maybe this isn't so restrictive for capital markets. It might be restrictive for families, for individuals. But for capital markets, that's fueling capital raises that we haven't seen before. And you're seeing everybody with their hand out. It's governments, it's tech companies, it's not tech companies that need to invest in all of these commodities that are increasing in the prices. And if the market is able to fund it, well, they can still pay for it and pay for higher prices. And guess what? That affects how much you're paying for your smartphone and how much you're paying for your life.
The crowding out is building, and you can see it. And there's just little bits of evidence building up that you're getting some pushback in the equity market. Friday, decent example. Meta in the FT, considering raising equity capital in a similar way to what Alphabet did a few days previously. Just last week, Alphabet raising $85 billion in equity capital. Massive number. Supermicro this morning looking to raise $7 billion in an equity deal for AI equipment. Look at that stock this morning, down by 10% in the pre-market. So you're starting to see the evidence just pile up, just little bits here and there. I don't think it's massive pushback, but just small signs of evidence that we're pushing things too far.
At a certain point, there has to be a finite amount of money unless you start printing it. And if you start printing it, well, then we've got another inflation problem. But you start thinking about what Annmarie was mentioning, which is, where is the money going to come from to buy SpaceX that's going to start trading on Friday? And it possibly is going to come from a lot of index fund buying, right? So how are these index funds potentially rearranging their portfolios to absorb about 30% of the total float, which is what the expectation is right now?
Futures this morning down by 0.75% on the S&P 500. Coming up this hour, Jim Bianco of Bianco Research as the market sell-off is deepening. Laura Galante of WestExec Advisors with President Trump eyeing a piece of the AI pie. And Tony Rodriguez of Nuveen on how big tech is contributing to inflation. We begin this hour with stocks adding to losses. Jim Bianco of Bianco Research writing the market is operating under the assumption that the AI industry is not a bubble. AI is currently in a hype cycle. Jim joins us now for more. Jim, good morning.
Good morning.
We'll save the sports. We'll put that at the end, all right? Let's start with the financial markets. The hype. How much hype is there right now into this IPO?
Oh, I think it's off the charts right now as far as the hype goes. That AI is the biggest technology that we've seen probably in our lifetime. Everybody's investing in it. They've sold it. I'm talking about Dario Amante and Sam Altman, that if you don't invest in our company at $1 trillion valuation, everything else, everybody's going to lose their job and everything else is going to be worth zero. So they've really hyped it a lot. And so two things can be true at the same time. The technology could be very real and it could be very transformative. And we've also kind of overhyped these companies.
It's like employment protection, isn't it? We've said that a few times. You're all going to lose your jobs. You might as well buy the stock.
Yeah, you might as well buy risk on with absolutely everything and give your money away. That's how my father feels.
Do you think we're getting some pushback in capital markets now? Is it starting to build? Just small signs here, there and there.
Yes, I think so. And also I think that there's been a narrative out there that makes a little bit of sense, that the sell-off we've seen this week is preparation for SpaceX on Friday. Where's the money going to come from to buy the IPO? Well, we're finding it out with the sell-off in the last couple of days. But yeah, I think we are starting to see a little bit of a pushback. But, that's to be expected. Remember, we had an 8-week, 9 consecutive day rally going into the top. This is the kind of correction you get after that run of that magnitude.
Well, we're getting a pullback again this morning. Bring up the chart on the S&P 500. Session lows down 1%. Some comments from the president. Iran will have to pay the price. Iran is all talk and no action. Iran has taken too long to negotiate a deal.
They've taken too long to negotiate a deal, says the president, and that would have been great for them, he thinks. Quote, now they will have to pay the price. So this is definitely rhetoric in terms of escalation, not de-escalation. Just 2 days ago, I was with the president. He said we were 2 or 3 days away. Potentially, it could be very quick to get to an endpoint. He clearly is not happy with what's going on the negotiating table. He clearly is not happy with the fact that they downed a U.S. helicopter. We saw retaliation for that. It sounds like at the moment, if you take his words for real, that potentially we could see more retaliation.
Bring up crude. Brent, WTI. Push that story, those headlines, through the energy market. It's worth not even a 2% rally on Brent crude this morning, just short of 93.
I was just thinking, as Annmarie was talking, this market's not biting. I mean, essentially, people don't believe that there's going to be a real reacceleration, and you can see that in the muted price action.
Jim Bianco, why are we ignoring these headlines this morning? What do you make of this?
I think there's headline fatigue. I mean, a little bit of that because we've been going back and forth with it. I also think that there's a trouble trying to understand this current state of the crude oil market. How much are we running down inventories? How much is actually sneaking out of the Strait of Hormuz? Kuwait is now starting to ask that they're going to start shipping oil. How are they going to pull that off? I thought the Strait was closed. Maybe it's not. So there's a lot of other things going on in this market than just whether or not the president says we're going to go to war or not.
There is a feeling that even if prices stay here for oil, that companies can absorb it, that essentially it's not a deal killer and that it's not going to really cause this disinflationary demand destruction that people had expected. I mean, how do you fold that into your feeling about AI and the narrative there that's driving everybody to look past all of these real geopolitical risks and the potential inflationary inputs?
Well, you're right. If the price of oil stays where it is right now, it's not a big deal. It can be handled. But the question is, will it stay at this level? Because the push-pull is, as long as the price of oil stays at $90, there's no urgency to do anything about the Strait of Hormuz. And then it just continues and continues, and inventories run down. And do we eventually hit that low where we've kind of run out of inventories and then we see a spike in oil later on? It would almost be better off if the price of oil was going up now, because then there'd be more of an urgency to put a resolution into this situation instead of just dragging it out as we've seen.
We have seen, though, these choke points emerge, right, where suddenly the physical assets become very desirable and people are willing to pay almost any price for them. And we see that in the chip sector. We see that with some of the precious metals. And then you see these companies raising more debt to pay for the higher prices as everybody tries to get in. Does that worry you that sort of there is this leveraged cycle going on in a way?
The leverage cycle is actually working to some extent, too. If you remember that image that we talked about last year where everybody owns everybody else, and at the center of it was Anthropic, which has now gone from $380 billion in the first quarter to $956 billion now. And all that is now showing up in people like Amazon and Microsoft's income statements as other income. And so it's actually helping the stock market go up for a moment. But yeah, you're right. The whole premise on AI is that it's going to replace SaaS. This is really what it's going to do. That, as I like to say, there's a keyboard in front of us. In 2 years, we won't need these because we'll just have a context window. We'll just ask our computer what we want. It will produce the result we need. And so the whole interface that we'll have with computers will very well change. If that happens, then all this spending that we're seeing on AI is not overdone. But if in a couple of years, we're still going to need all the software that we personally have, plus everything else, and we also pay for AI, then it is overdone. So will it meet that promise that it's going to fundamentally change the way we interact with data through software in a computer? If it does, it's not overdone.
That sounds more expensive than hiring someone to type.
It might be now, but the hope is that the cost will come down in the future. And that's really where we are. If you want an analogy of what we're talking about here is the iPhone. Why do we pay $1,100 for an iPhone? It's not to make phone calls. It's that I don't need to buy a camera. I don't need to buy a video recorder. I don't need to buy a tape recorder or a photo album or anything else, or a calculator or a flashlight. It's all in one device, so I'm happy to pay that kind of price. Well, if I don't have to pay for all this software and everything else, I'm happy to pay higher prices for AI, but it has to fulfill that promise. If it does, then it's not overdone.
When it comes to what is going on, back to the president's truth about Strait of Hermes, he also said recently to the New York Post, potentially, that we could be here until September. Would that have any impact?
Well, if it runs down inventories, if the idea here is why we're at $90 is because we're offsetting it through less demand from China, who's running down their enormous inventories, and everybody else. So as long as inventories keep having room to be drawn down, we could make it to September. If we get to that, operational limit that everybody talks about, then we will run into problems. It's hard to say where that level is, but the argument is, and I believe it, it's months, it's not years or anything like that.
Hey, Jim, it's good to see you in person. You want to squeeze in the rant about basketball, about New York sports? Do you want to get that in?
Yeah, well,
some friends ahead of client meetings a little bit later today. Go for it.
Right. I saw this with the Cubs 10 years ago. People were so invested in this team winning. They stood the whole game. You put so much pressure on the team, they lost all the home games. And they had to wind up winning the series on the road. And the Knicks might have to do the same thing.
Jim, it's good to see you.
Good to see you
in person too, buddy.
Thank you.
Thanks for dropping by. Jim Bianco there of Bianco Research. If you are just joining us, welcome to the programme. So these headlines just dropping just moments ago. This statement from the President of the United States. He has taken a lot in the last week, accepted it and committed to de-escalation and diplomacy. Is that about to change? Check this out. Iran's military is a complete and total mess. Much of it, like their Navy and Air Force, doesn't even exist anymore. They've been completely defeated. Iran is all talk and no action. The bully of the Middle East is dead. They've taken too long to negotiate a deal that would have been great for them. Now they will have to pay the price.
It does look like his patience is wearing thin this morning, although we have to note we have been here before. Is this negotiating tactic from the president to put out truth like this, talking tough, to try to get them to have an agreement, because he has been hanging on to this ceasefire and he keeps signaling that he wants a peace agreement. But when I was with him on Friday and he was speaking to farmers, he said, and farmers who are dealing with higher fertilizer prices, higher diesel prices, he said it's either going to end with a piece of paper or another way. It'll be a harder way, maybe a quicker, but he was talking about more escalation.
Brent crude this morning up just 1% off the back of these headlines. Equities were already lower, down just a little bit more. We're negative by 0.9%, call it down 1% on the S&P 500. With an update on stories worldwide this morning with your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Progressive Democrat Graham Plattner winning Maine's Senate primary. Plattner's campaign was plagued by a series of scandals and accusations of past misbehaviour. He'll face Republican Susan Collins in November. She ran uncontested in her bid for a 6th Senate term. California's SoFi Stadium averting a workers' strike just days before it's set to host the U.S. team's first World Cup match. Workers are scheduled to vote on ratification of the agreement, which will expire in April 2028 ahead of the Summer Olympics in Los Angeles. President Trump saying Iran is all talk and no action when it comes to working on a peace plan. The president saying Iran has taken too long to make a deal and will have to pay the price. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you for the update. Up next, we'll get you an update on just that down in Washington, D.C. We'll catch up with Tyler Kendall in just a moment. Equity futures just off session lows. We're down almost 1% on the S&P from New York City this morning. Good morning. Live from New York City this morning. Good morning. Check out the price action. Tech declines across the board. The Nasdaq down by 1.3%. The S&P down by 0.9%. The losses building up just a moment ago. More signs of increased tension between Iran and the United States contributing to that. Just on the margins. Check out the bond market. 2s, 10s, 30s. Yields shaping up as follows. 2-year yields up by a single basis point. And crude barely blinking off the back of some important developments taking place right now. A developing story with crude. Brent at 92 and up just 1%. WTI still holding on to an 89 handle. Under surveillance this morning, a renewed threat to Iran.
I would say the ceasefire is on massive life support. If there's no ceasefire, you're not going to have to know. You're just going to have to look at one big glow coming out of Iran. In that part of the world, ceasefire is when you're shooting in a more moderate manner. There's a reason for everything. And we hit them pretty hard. We're going to win one way or the other. It's going to be militarily or on paper.
So here's the latest this morning. President Donald Trump issuing a new threat to Iran. The president posting on social media moments ago, Iran has taken too long to negotiate a deal that would have been great for them. Now they'll have to pay the price. Bloomberg's Tyler Kendall joins us now for more. Hey, Tyler.
Hey, John, good morning. Well, it's clear that President Trump's patience is now wearing thin as he issues this new threat about Iran taking too long to come to the negotiating table. It's raising questions about what could be the U.S.'s next steps here after President Trump over the weekend in an interview outlined that his potential red lines for ending the ceasefire would be if Americans were killed or if he feels that a deal could not be reached or reached fast enough. Keep in mind, after we saw the worst flare-up in fighting earlier this week between Israel and Iran, our analysts at Bloomberg Economics said that this could represent two things. One, Iran may feel more emboldened to flex its muscles amid the ongoing negotiations being dragged out. Or two, this could be the start of a wider escalation spiral. We'll have to see where this goes from here, because we did see the U.S. respond last night to an American military helicopter being shot down. While Iran hasn't denied that its forces were involved in that attack, it has indicated that perhaps it wasn't intentional in that helicopter going down, but it certainly flared with the tensions overnight, with both sides exchanging fresh fire. John, at this point, the White House still maintains that diplomacy is a viable option. Whether or not President Trump's comments change that remains to be seen. A person familiar with the matter did tell Bloomberg News overnight that the two sides do continue negotiations. They call the negotiations, quote, intense, and that they are being mediated continuously by Pakistan.
Tyler Kendall down in Washington, D.C. Tyler, thank you. You read those headlines, you put together the stories of the last week. We said it earlier this morning, every single reason building up for a high crude price, and you don't see it on the screen this morning. We're up by just 1%.
Well, I think Jim Bianco really spoke to something that people in the oil industry are talking about, the fact that Kuwaiti barrels for the first time are starting to get out. They're going to China. ADNOC is getting stuff out. You had an Emirati delegation, Iranian delegation meeting when it comes to economic cooperation. Phone calls between Tehran and Riyadh continue. So maybe on the margins, more oil is coming out of the region than we can really understand. And that is what's keeping a little bit of a lid on prices. And on top of that, you got the verbal intervention of the president almost consistently, besides this morning, that he wants to see a peace settlement.
This wasn't meant to be the focus down in Washington, D.C. today. The focus was meant to be a meeting. Still don't know if that meeting's taking place between the president and a bunch of founders, leaders of the OpenAI Anthropic world.
You always call it the phantom call in Trump's first administration.
Is this the phantom meeting?
This feels like a phantom meeting because the president told us on Air Force One, and he was like, did you guys know about that? And we were like, no, please tell us more. Who's going to be attending? He says there's going to be a meeting this week between, he said, all of the big ones, so Anthropic, OpenAI, SpaceX, when it comes to how there could be some sort of financing, public-private partnership. Some are even saying go as far as what they would call nationalization of these companies, the government taking equity stakes, yet there is no meeting. Potentially, though, there's one on the horizon. The president is manifesting.
A notice reporting that maybe the companies weren't even aware of this meeting.
Yes.
Ahead of this meeting. Laura Galante of WestExec Advisors and member of the OpenAI Frontier Risk Council writing the following. The Trump administration has already supported government involvement in strategically important sectors. AI seems to be the next category. Laura joins us now for more. Laura, welcome to the programme. What is the argument to take stakes in these companies?
Jonathan, the argument is around the national competitiveness of what AI brings to the U.S. So there's two pieces that I think Trump's reacting to, and Bernie has a proposal on this as well, where they're looking for ways, the administration's looking for ways to take the wealth that is going to be coming and is coming from these AI companies, from the transformation that's happening. And also, there's a public risk and an exposure piece here that's coming down the line, too, ahead of these IPOs. And look at this and say, how do you keep the innovation moving forward? How do you keep this competitive advantage moving forward, especially vis-a-vis China? And this ownership question, do you take a stake in these companies, is really where, the debate's focused the last couple of weeks. But what are we trying to achieve, and are there ways to do that that still give a competitive edge to the U.S. and to this technology.
One key point will be who are the personnel staffings that are going to make some of these decisions and have the expertise. Laura, we've seen a number of individuals depart the White House recently, most recently Thomas Lind, who had really been the architect behind a lot of the AI strategy of the White House. Does that concern you?
I think that more than, a single person here or there moving on in terms of strategy, the question is what tools and who is going to be thinking through creative ways to either do competitiveness policy, do industrial policy, and look for ways to keep the innovation moving, to keep these companies in a place where they can have a public discussion around risks, and then be able to channel that to the levers of state that you have when you're sitting as an incumbent administration. And I think the capacity question that you're getting at is huge here. Do you have the people? Do you have the expertise? And then do you have the channel established? What's been really interesting to me is watching OpenAI and Anthropic put out these public policy statements and put out these very clear questions around how should you regulate us? Should we have sovereign wealth funds to figure out how to distribute the dividends here? They're putting out policy hooks. They're putting out big questions saying, we don't have the answers, but we're open to the dialogue. Is the White House, is the administration poised to be able to start answering those questions? That's the big discussion here in Washington, and also really key to how we get policy that is effective here.
Laura, one advisor who's now left, but still close to the president, of course, David Sachs, says America won't win the AI race if we beat China, but end up with a CCP-style social credit system in the U.S. And the dangers that the government becomes more deeply involved in these AI developments. Isn't there a risk of this idea of nationalization? This is not free markets and what Republicans think of them.
Certainly. The concept of an ownership stake in an American company is such a rare occurrence. We have to think back to the 2008 financial crisis, other huge national emergencies, to even have the paradigm here of the U.S. government taking a stake in a company. On the other hand, you look at what the administration did with Intel, the $9 billion investment there on the chip side, a la 10% of Intel, a pretty decent stake. And you're looking at a new question of how do you have a place at the table with this technology? But then you have this call, and you hear it in David Sachs, you hear it in a lot of traditional Republicans and across the aisle, of is this socialism? Is this picking winners and losers? Is there a risk here of anti-competitiveness? And I think that's a really legitimate concern. So how do you get at the objective you want? And the question that I think people are going to keep grappling with are, whatever the lever is to extract some level of ownership or wealth from the dividends that are coming from AI, what container do you use to put that in? Is it a sovereign wealth fund? Is it competitiveness and infrastructure build out? China's been doing this state fusion industrial policy concept for decades. We're not going to beat China at its own game, but we can turbocharge the innovation system that we have here in the U.S.
Laura, appreciate your time. The debate will continue. Laura Galante there of WestExec Advisors. I draw a line between Intel and what's happening here. I think you can make the case with Intel there was a gap in private investment, that the government was looking to sacrifice free markets to the altar of national security, and we need to support a build-out here domestically for that reason. I don't think you can make the argument there's a gap in private investment right now. This is about redistribution of very narrow gains in this economy.
No one can look at this market and say that these companies can't raise money. Tell me that with a straight face, and I'll laugh all the way to the door.
This one feels different. Let's put it that way. Coming up, Henry McVey of KKR out with a fresh mid-year report saying the Fed's easing cycle is fading. A few headlines from the president in the last 20 minutes or so. Here's the latest from the president of the United States on the situation with Iran. They've taken too long to negotiate a deal that would have been great for them. Now they have to pay the price. Just moments ago, telling Fox News he's close to ordering new strikes on the country.
So we've seen a defensive posture from this administration. We've seen some assertiveness from the Iranians, like downing an American helicopter, and they responded. Now it does seem like the president, his patience is wearing thin, and according to Fox, he's saying he's close to ordering new strikes on Iran. So that would mean that the president is not choosing the diplomatic option that he has been hanging on to for so long. Just Monday evening, he told us that potentially we could have an agreement in 2 to 3 days. Well, this does not sound like we're getting close to any sort of agreement.
It's not much of a bounce in crude, though. Check it out. Brent and WTI up by not even 2% off the back of this. WTI still trading in the 80s, just about. Brent crude short of 93.
I mean, this is the idea that the market keeps getting at. The second derivative gone amok, where essentially nobody is going to allow prices to get that high. So there will be a resolution, so the prices don't ever get that high, so there's no resolution. And that's essentially the doom loop that we're in right now.
Going into CPI later this morning, 60 minutes away, with yields just a little bit elevated. 2s out to 30s, up a basis point or two, and equities declining on the S&P 500 this morning. Session lows down 1% on the S&P. Tech is a factor here. Wild swings in chips in the last 24 hours. Wild swings in chips over the last 3 sessions. Make it 4. The Nasdaq 100 down by 1.5% this morning. Let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. Supermicro is the latest company to join the party in raising capital, announcing a $7 billion equity raise, but shares are falling some 12% now since it is a diluting event. Sales of its AI servers have surged, so the company says it needs more cash to fulfill some $39 billion in orders. And the problem for AI server companies like this one is that they have to spend heavily upfront on chips and other components, which we know have gotten pricier. Speaking of chips, as you just mentioned, we are seeing a second day of weakness in the chip sector, with names like Micron, Intel, AMD, and NVIDIA all lower after we saw a wild session yesterday for the semiconductor stocks, with the Philadelphia Semiconductor Index falling some 10% at its lows before recovering, but still ending the day in the red as investors lock in profits in the market's hottest trade, but also maybe make some room for SpaceX. And we end on the restaurant chain Cracker Barrel. Shares are surging nearly 10% in the pre-market after it raised its full-year outlook. Remember, it got major backlash after its rebrand, but now it's trying to make up for it by leaning more into its Americana brand, and that seems to be working for the company. John?
Yahira, thank you. Thanks for the update. Appreciate it. More from Yahira in the next hour. On our radar this morning, Anthropic set to release a new version of Mythos called Fable 5, designed with strict guardrails to block cybersecurity tasks. The company also announcing Mythos 5 without those safeguards that will be available to select groups. Elsewhere, New York City Comptroller Mark Levine blasting Elon Musk's, quote, unprecedented control over SpaceX. Levine warning Musk's 80% voting power disregards investor rights, adding it would be complicated to exclude SpaceX from public pension funds. And finally, Yahira's been on top of the story all morning. Shares of Supermicro Computer falling in pre-market trading. The company aiming to raise $7 billion through a package of equity offerings in an effort to purchase the equipment needed to fulfill AI server orders.
Is there room in the market right now for other companies other than SpaceX or potentially Anthropic and OpenAI to raise money? And potentially, are they going to be charged that much more of a premium? And that's the takeaway here. Also, this is money that's going to go toward building the server parts to pay for existing orders. This isn't speculative, and yet it just highlights how robust the demand is, how unable people are to keep up, and the increase in prices that they have to pay to obtain some of those materials that they then have to finance in the debt markets. I mean, again, the capital raising that's going on right now is a bit mind-blowing.
Never mind the IPOs. They're not waiting for the IPOs.
Oh, okay.
Alphabet, upsized capital raise of $85 billion. We've mentioned that report in the FT on Friday around Meta doing the same thing. This again. And the equity market started to push back. Now, how much tolerance these C-suites have for that equity pain is something we'll have to debate in the weeks and months to come.
And just to build on what you're talking about, it's an important point. They've tapped the debt market. They're worried about tapping the debt market too much. So now they're going to the equity market and saying, you too need to bear part of this, because we can't just go to the debt market. It speaks to the scope of financing that needs to get raised. And to Jim Bianco's point, either this is a revolution that is going to change the way we do everything in a couple of years, or this is an overpriced proposition. Most people seem to believe the former, not the latter.
Kevin Warsh is going to have a really hard task next week talking about some of this. Speaking of, KKR releasing their mid-year outlook, highlighting the top themes from the first half and looking ahead to the rest of the year, including a fresh outlook on the Fed, with Kevin Warsh's first meeting as chair a week away. The team over at KKR writing the easing cycle is fading, and the next debate maybe more about how long policy stays restrictive. We have removed our 126 rate cut from our forecast. Henry McVey of KKR joins us now for more. Henry, good morning. Good to see you.
Good to see you.
Thanks for being here, sir. Let's get into this. How have things changed for this Federal Reserve in the last few months?
Look, I think what's become very clear is, and it's kind of the title of the piece, we're calling this the divergence conundrum. Half the world is having massive spending increases around national security and then around AI, and that is almost spending. It's an existential threat. You look at the other half of the economy around goods and housing, and it's depressed. So you have this pendulum, like which way do you go? If you're it's a little bit of a seesaw. And the central bank is getting mixed signals, right? Interest rates are a blunt instrument. You probably should be raising rates to restrict the pace of growth in the build out of the national security and the AI, but you probably should be cutting rates to help the lower income as well as the housing market. So that is really what the piece outlines. And there are really three other periods in history: the 1870s, the 1920s, and the 1990s. Usually comes with some type of industrial revolution and productivity boom. My gut is that that the new Fed chair, what they'll try to do is do no harm in June, right? Which is, this is probably not the time to make a massive pivot one way or the other. But my gut is that, I thought Larry Logan and others were right when they moved to a more neutral posture. We have 150 to 200 companies around the world. We have a great headlight system on what you're seeing, and prices paid are going up around the world. They are, right? There are two things going on. One is this demand-driven need for AI, because you need to cement your competitive position. The second is that more and more countries are realizing how to leverage economic choke points for political gains.
Can you make the argument also there's an extra wrinkle here, that the consumer's rate sensitive and all this spending we're seeing isn't? Is that an extra problem for this Fed?
I actually think that what's most interesting about this cycle from a leverage standpoint is we've always lived in a world, since I've known you guys, where the consumer levered up and the corporate levered up and the government delevered. Right now, the consumer, in anticipation of what's going on with the government debt markets, has delevered in aggregate. And the corporate, even though we're seeing a lot of issuance right now, by and large, they have much lower levels. So there are signaling mechanisms going on. The offset of that is when the governments went crazy after COVID by priming the pump, they really ramped up their leverage. And that's what's leading to this breakdown for most CIOs, is that their shock absorbers, which are traditionally risk-free rates, are not acting like risk-free rates, right? Japan's bond market selling off because you've moved from deflation to inflation. The UK is the tip of the sphere, right? Which is, you've got, if you raise taxes, everybody complains. If you don't raise taxes, then they want to sell the bond market off. And the US is the third, and around Liberation Day and some other areas, it's just the bonds are no longer providing that stability that they did, and it's one of the things that we think is different about this cycle. We've been highlighting that for some time, but that really fits into this narrative, which is you do have this higher resting heart rate for inflation.
They're not providing the stability. Are they the source of risk right now as governments sell bonds at the fastest pace in history?
Yeah, I think we're running. I think we're running. Debt levels running at these same rates for some time will continue to be problematic, and it's one of the reasons we would argue you need to think about other things in your portfolio. We obviously sit on top of we manage $800 billion of private assets, so we have our own views around private equity and infrastructure and asset-based finance. But I think this is true from the individual investor all the way up to the institutional investor, that this time is different.
There is a feeling right now that there are pockets of froth that have yet to be worked out of the system, and that there is a lot of money chasing AI. Inevitably, some of it will be lost in big swaths. Yeah. You say that at some point there will be some sort of rebalancing that ultimately will be required. Can you explain what that means?
So if you go, to me, I mentioned those periods, the 1870s, the 1920s, and 1990s. This is probably most akin to the railroad build out in the 1870s. Railroads actually came about 60% of the market. Of the market cap, right? So it can go on for longer than what you think. And the other thing is if you look, and we see this internally, I would say most CEOs who come on your show are talking about AI productivity. The boom that we've had the past 8 to 10 quarters is not AI. It is started after COVID with automation, digitalization, machine learning. We are just at the start of the AI productivity. And most people are going to like it, they're going to get benefits, and they're going to spend more, because they're going to want to get that internal leverage of the productivity for their employees. So I think the spend signal is actually to keep going, not to slow down. look, we know from the telecom issues in 2001, these things do get overbuilt. And so there will probably be some overbuilding. And we also don't know which large language model is going to win. So to me, this is know thy customer, make sure you have contracted revenues, and don't do the if they'll build it, will come. I think you're going to see some of that. That's not what we're trying to do as a firm. Particularly, we have a leading infrastructure franchise. We do a lot in AI and the data center build out, but we're trying to be disciplined around that.
Won't they all win if the United States government decides they're going to take a stake in them?
Yeah, I heard your earlier comments. I think this is actually an excellent point. What I see when you go around the world is that countries are having very different reactions to AI. To me, China and the U.S. are the two leads. The U.S. is going for a very high-end corporate model. I would say China is going much more consumer, open source. They're probably going to be the leads. I think there will probably be some convergence of church and state between the private and the public sector. But what's also interesting that people don't talk about, if you go to Japan, they have to have AI because there are not enough people. They're saying bring it on. If you go to India, they got to put 16 million people into the workforce every year. And IT outsourcing was one of their number one exports. That's probably a little more tense. So I think it's a much more nuanced story than what you hear on the global headlines. And really what we've tried to do through our global footprint is figure out, it's not a one size fits all, and try to figure out within these different economies, what do they need? Some need more power, some need more chips, some need more infrastructure to get the locations built. And so it is really a time to drill in. I think a little bit where you were going, somebody will overbuild, right? That's just the nature of these big industrial revolutions. But the power and the productivity that you get from it are will be very powerful, and we just need to navigate that. And I think the report does a good job of laying out where we think investors should tilt.
Can we finish on, Henry, one thing we are guaranteed of getting more of, and that's more equity supply?
Yeah.
How the supply-demand backdrop is shifting and how you and the team are thinking about that?
Yeah, I mean, I think we've been, we obviously focus on fundamentals and we try to make companies go from good to great. Doing this for some time, I focus a lot like you guys do on the technicals. The technicals have been as good as they could be for the last 30 years that I see. I measure IPOs, levered loans, and high yield issuance as a percentage of GDP. It has been at 3%. That is 2009's levels. In 2021, that was 8%. But as you guys are reporting, guess which way the chart's going? It's getting into the middle. So we're not at red alarm and where we were in 2021, but we've left green. And so I think that's something as this story unfolds, and Lisa and you were talking about this earlier, which is it's not just the debt. You can't just keep issuing debt. You've got to put some equity into the structure too. And can the market digest that? And so we'll have to watch. But it's definitely going from a very green, incredibly positive backdrop to one that's more mixed. My personal take is it's actually not going to be the IPOs. It will be in 2027 where you have the secondary supply when the unlocks come on. So the IPOs are going to make the headlines, but when you look at it in aggregate, it's probably 300 and 400 billion. That's not a teeny number, but relative to what can come on the supply, that's more problematic.
As you look across asset classes right now, which part of the market is more vulnerable to so-called crowding out with all the supply coming through, both in debt and equity?
I think look, to me, most investors are globally underweight infrastructure. They have about 3% of their portfolios in that. That probably should be double. That's going to grow. The tech boom is where you've seen the excess, and it's hard to argue. You have this difficult thing because semiconductor chips, particularly in Korea and other places, are trading like 7 times earnings. They're growing 100%. So it's going to be what's embedded in the price, and it's going to be the second derivative. Our model is showing very strong earnings growth through 26 and then starts to slow down in 27. Higher rates, tightening central banks, and oil. Oil's actually not a coincident indicator. It's a lagging indicator. Usually comes through the system about 12 to 15 months later. So I think what you want to, I think this year we have the chance that we beat earnings nicely and it keeps the market doing okay. I think when you look more towards the second half of 27, that's where we would see a little bit of softness in the earnings.
Henry, this was a privilege, a pleasure. Thank you,
Always
sir.
Always great to see you guys.
One of those conversations I'll go home and listen back to. Henry McVey there of KKR. Lisa was talking about the record debt that we've seen so far. Hannah Benjamin Cook and the team here at Bloomberg put some numbers on that. $504 billion of debt, sovereign, issued so far this year, more than the first half of 2020. Think about how much was issued through the first half of 2020. We've beaten that.
Yeah, well, prices are rising and the governments want to get on it too because they're all trying to solidify some of their domestic security and their critical minerals. What Henry McVey also wrote about in this piece, which I thought was really interesting, was that during times of industrial revolutions, there tends to be a confluence between government affairs and government issues and political issues and economic ones. And we're seeing that in a massive way. And you see it particularly in the physical goods space.
Some big shifts, that's for sure. The S&P this morning, session lows were down 1.1% on the S&P with an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. President Donald Trump telling Fox he's close to ordering new strikes on Iran. The warning coming after Trump posted on Truth Social, Iran will, quote, pay the price for taking too long to negotiate a peace deal. Trump going on to post about the U.S. blockade of the Strait of Hormuz, writing, quote, nothing gets through unless we want it to. It is a steel wall. Iran is doing zero business, not paying their military or any of their bills, and quickly becoming a failed nation, unquote. TSMC reporting a 30% rise in its monthly sales. The increase reflecting continued strength in demand spurred by a global rush to build AI infrastructure. Asia's largest company has become an essential global AI player by making cutting-edge semiconductors for companies including NVIDIA and AMD. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for the update. More from Vonnie in the next hour. Up next on the programme, big tech driving inflation higher.
Inflation remains above target. I think that the rate-insensitive purchasers, the hyperscalers, that really hits the nail on the head. That is inflation or overheating. This is increased demand outstripping supply and raising prices.
Up next, Tony Rodriguez of Nuveen. Equities declining here. We're down 1% on the S&P 500, negative almost 1.7 on the Nasdaq. It's been a wild ride for tech in the past few days, going into a record-breaking IPO in the next few days from SpaceX. Adding to this move lower, some comments from the president a little bit earlier, losing some patience with the Iranians. Only 24 hours ago, not even, the president was talking about closing on a deal with them, and now it's maybe striking them again.
Yeah, he said that to my face. He said it could be 2 to 3 days. And I said, did you mean weeks? Because he usually likes to do 2-week increments. He said, nope, I mean days. So now he's saying that basically when it comes to Iran, they've taken too long, in his mind, to negotiate a deal. He said it would have been great for them. Now they will have to pay the price. So everyone is expecting 2 things. One, is the president just using rhetoric to negotiate better terms or try to get the Iranians back to the table? Because we don't really have a lot of insight on where they are in the stages of these talks. Or is he serious? And we're going to see more strikes.
You wouldn't know based on this move in crude. Said this a few times. Brent this morning, around 93. Under surveillance this morning, focused on CPI at 8:30 Eastern Time. Big tech driving inflation higher.
Inflation remains above target. I think that the rate-insensitive purchasers, the hyperscalers, that really hits the nail on the head. That is inflation or overheating. This is increased demand outstripping supply and raising prices. It's not something that is going to return anywhere close to 2% this year.
So here's the latest this morning. Investors bracing for fresh inflation data due out today, expecting CPI to hit multi-year highs. Some on Wall Street warning big tech's AI spending spree could continue driving up prices. Tony Rodriguez of Nuveen writing, tech-related investment is now contributing to inflation. We expect this tailwind to remain over the rest of 26 and into 27. Tony joins us now for more. Tony, good morning.
Good morning.
Does the Fed have to respond to that?
We think the Fed is responding because we think the Fed was going to be cutting, so they're responding by delaying cuts. So we don't think the Fed's going to need to respond by raising rates at the moment. Now, if things really get much worse on the energy side because of what's happening in the Middle East, that could maybe push the needle towards needing a hike. But right now, what we think has happened is cuts are off the table for the balance of the year. And you need to see maybe into the middle of next year when you get some easing in the inflationary pressures.
It's inevitable that I'd ask this question. What is much worse? What does that look like?
Well, right now, if you look at energy prices and you look at kind of the futures curve, you're looking at around $85 oil at the end of the year. That's the highest it's been all year. If you just see that get up closer to $100, that's going to cause it to continue to push into the end of 2027. And I think at that point, you'll start to see the Fed need to. Right now, we think they need to take the easing bias off. By the time you get to September, if you're looking at a futures curve that's pricing $100 oil because Middle East developments have deteriorated, then I think you're going to be looking at a hike.
Are we being too cute about this, given the fact that yields are higher and that you're seeing inflation potentially running at the highest pace going back 3 years when the Fed was in a hiking cycle? Are we being overly optimistic about the disinflationary forces and the ability for consumers to just look at a very narrow selection of goods and price increases there?
Yeah, I don't think so, because I think if you were to continue to see this kind of pace of energy price increases, for example, the demand destruction becomes that much more acute. So right now you're already seeing some demand destruction, particularly when we're talking about lower income households because just of gas prices, et cetera. That would really begin to pinch even further. And then I think you'd see declines in consumer spending, increases in consumer delinquencies and defaults. So the demand destruction element would, I think, temper any need for the Fed to have to react to energy prices if they keep rising at this pace.
Are you seeing any demand destruction or destruction of appetite by investors to keep lending to tech investors right now with rates where they are and with some of the price pressures?
Yeah, I would say no, but I think one of the big reasons that's occurring is because most of the very large hyperscalers are actually also leaning into the equity market to help support their balance sheet a bit. So I think if you didn't see that, then I think the appetite in the fixed income market would not be there, and you would see a much higher increase in rates, widening in spreads, et cetera. But the fact that they're being somewhat careful about their balance sheet strength and using the equity market to help finance some of that, I think then the demand on the fixed income side will be there.
Steve Chaudhuri brought up a good point in the earlier hour about how if you were going to hike rates, it's not going to stop this AI trade, and it's just going to hurt the lower income individuals across the country. Do you think that's the message Kevin Warsh is going to potentially hint at next week?
Well, I think if the question is directly related to do you hike over AI spending, he may point to that because, yes, the Fed really can't do anything about that, just like the Fed can't really do anything about what's happening in the Middle East, right? So they are going to try to look through as far as they possibly can, but at some point, back to like, hey, if at year end energy prices are $100 or staying in those, this $90 range, then you can no longer look through it as easily and as rationally.
What do you think the dots look like next Wednesday?
What's that?
What does that dot plot look like next Wednesday?
That's interesting because you have a little bit of just responding to the actual macro developments that have occurred, and you have a little bit of what I would think is maybe positioning in terms of how they want to see themselves versus what they think Warsh and signaling where they want to be. So I think you're going to see dots that increase a bit.
Anne-Marie's on the no dot.
No doubt.
No dot camp.
I'm in the Jackson Pollock camp. Just throwing paint at the wall and essentially seeing what happens.
Might not put a dot on.
You lost me for a moment.
Okay.
Now I'm with you.
Just like a spray of dots at all different places and being like, figure it out. It's useless anyway.
Tony, it's good to see you. Thanks for being here.
See you guys.
Thank you, sir. Tony Rodriguez of Nuveen. Looking for inflation to come in with a four handle. We haven't seen that for 3 years. The last time the Fed saw that, the Fed funds, the upper bound, had a 5 handle. Has a 3 handle now. Things have changed a lot. Coming up next, we'll catch up with Chaudhuri of BlackRock, Dan Ives of Wedbush, Tiffany Wilding of Pimco, David Kelly of JPMorgan Asset Management with inflation on deck. That data point, 34 minutes away.
The markets are wagging the economy, not the other way around.
The majority of the opportunity here is really in the AI compute space.
As long as the capital markets remain open to these really massive market caps, that's the opportunity.
This is really, I think, an earnings-driven story.
It could be more choppy this summer, but we don't think that the bull market in equities is over.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your price action, the score looks like this. We're negative 1% on the S&P 500, down by 1.5% on the NASDAQ. In the bond market, yields shaping up as follows. 2s, 10s and 30s. Yields higher by 2 basis points on 2s, up 2 on 10s. Your 10-year, 4.54. Heading into this, 29 minutes away. CPI in America at 8:30 Eastern Time. We're looking for a 4 handle for the first time in 3 years on headline inflation in America. And it might get worse from here if things develop in the wrong way in the Middle East. The president earlier on this morning saying this about Iran. They've taken too long to negotiate a deal that would have been great for them. Now they'll have to pay the price. The energy market reaction, there isn't much of one. Up 2% on WTI, still just south of 90. Brent crude just below 93.
Headline fatigue. At what point are we people saying we've heard this all before? Every time a new headline comes off, we can't change our entire structure of trading. And there's a lot of feeling right now that, frankly, everyone's being manipulated in different ways. Without seeing action, people aren't going to move. Ultimately, they're looking at the supply and demand, oil barrels that are going across, the fact that the SPRs around the world are being dragged down, and it isn't having that much of a ramification.
First, we need to say we've been here before many times with the president in terms of using rhetoric and then he actually doesn't follow through with it. But it does seem to be this morning that his patience is wearing thin, especially since just the other night he told us we could have a peace agreement in 2 to 3 days, not weeks, 2 to 3 days. So now he's saying that Iran might have to pay the price. They're taking too long. And he's telling Fox News that potentially he's close to ordering new strikes. This wouldn't be defensive in responding to the Iranians, the IRGC downing a U.S. helicopter. This would be fresh kinetic strikes. So you would think oil would move higher. It's not at the moment, and that's because we've been here before.
There's a risk here, though, that we conflate the two stories too much. We're talking about CPI 8:30 Eastern Time. Yes, energy's a factor, a big factor, but the story has progressed in the last few months. There's a bigger focus now, I would suggest, much more so on the inflation taking place beyond just energy and what that means for interest rates. And when you speak to the people who are calling for tighter policy from the Federal Reserve, and you ask them a very basic question, how dependent is that call on what happens in the Middle East? And they say not very dependent at all. There's much happening elsewhere.
It's AI spending. Henry McVey was saying that he goes around and talks to all their portfolio companies, and they all say they're raising prices. They all say they're able to pass along the increases in input prices to their customers. I heard that over the past couple of days from a number of CEOs, their profit margins are expanding faster.
Tell us where you heard it, Bramo.
Well, in Rio. While I was in Rio, enjoying, the samba and the beautiful weather. Oh, it's gorgeous there. It's really nice. I highly
Tell us more,
recommend it.
please. I didn't know.
It's just the island's volcanic activity you can see from thousands, millions of years ago. Anyway, it really gives you a feeling, though, of strength, and that's the feeling that you feel all around.
What is the view like from the Bloomberg office in Rio?
I literally...
Is it better than the view in Manhattan?
Yes. That's a big yes.
I officially submitted a request for transfer.
Did you? Bureau chief. Does
Yes.
the bureau chief know about that? No. Job swap.
Honestly,
job swap.
I'll put snacks in the drawers. It's really gorgeous. They live well. They live well there.
So do you. Futures right now in the S&P 500. Totally jealous here, not pretending I'm not. Equity futures on the S&P down by 0.9%. Coming up this hour, we'll catch up with Gagi Chaudhuri of BlackRock with Markets on Edge, Tiffany Wilding of Pimco on the latest breaking inflation data, and David Kelly of JPMorgan Asset Management on investing in a diverging economy. We begin this hour with stocks sliding as fresh turbulence rocks the tech trade in the past few days, heading into this week's mega IPO. Gagi Chaudhuri of BlackRock writing, stay invested, but broaden the sources of return beyond the narrowest part of mega cap leadership. Gagi joins us now for more. Gagi, good morning.
Hi, good morning.
What's behind the volatility we've seen in the last few days?
Absolutely. So I think it's the trifecta of bad news that's hit the market. Obviously, the first came with it was good news, but interpreted as a more hawkish turn from the Fed with the payroll data last week. On top of that, this morning, obviously, we've seen some aggravation on the geopolitical front. And then lastly, already there's a little bit of concern around, how will the supply that's coming this week get absorbed in the market? So you take all of that, and then you combine that with the tremendous rally that we saw over the course of this whole year, but certainly May, and the very narrow rally, 80% of the returns of May came from just the top 10 names. So when you combine all of that together, I think it's really fair to expect to see a pullback. I call it a healthy pullback. I think earnings are still solid. I'm not worried about it, but there are some things that the market just needs to get through.
So we've got this really big, fat, nice earnings cushion supporting demand for equities. Got that. But now you've got all this supply. You talked about making space for it. Do we have enough space for all this supply?
It feels that way. And then, when we sort of talk to our clients, and I was on the road last week, I was in Mexico, not Brazil, but equally lovely. But just talking to our wealth and institutional clients there, as well as the United States, I think what clients are very excited about is this idea that there's all this IPO coming to the market, which does indicate a risk-taking environment, which does indicate to them that this is a good time to stay invested. Whether or not it's about this particular or that particular issuance, that's not what they're thinking talking about, what clients are talking to us about, is just ways in which they can add to durable growers in their portfolio. Now, having said all of that, there is a little bit of concern around how much the market has rallied over the course of the last month. And I think, again, this momentum unwind that we saw even yesterday when it was very sharp, very concentrated, I think that's something that we will get. And on top of that, you have the rate back up.
You're at the forefront of one of the hottest debates right now on Wall Street, which is the index composition as some of these IPOs come to market. The fact that a number of the indexes are going to be welcoming them in much sooner than previously expected. And then under this one change, that about 30% of SpaceX's free float is going to be going into indexes versus 4% had the index characteristics not been changed. For ETF buyers, how much do you think they're prepared for this? How much does this expose them?
You know, honestly, that's what we've been trying to do as a team, as an organization over the last month, just educate, right? And we're having some calls today as well inside the market webinar for our clients, which is just around, as an ETF buyer, here is what you get when you hold. You get transparency, you get liquidity, and that's perhaps one of the reasons that you do want to hold something in an ETF form, because you know exactly what your underlying holding is. And on the flip side, if you want to have a slightly larger allocation than you normally might get from an index, there are so many incredible active players that can get you that similar allocation, but maybe at a more nimble, moving around from one region to another. So I think our job here as market participants is to make sure that our clients understand that just because this is so hot right now and we're all talking about it and it's a very exciting time to be alive, doesn't necessarily mean...
You sound like someone who just got back from Mexico.
I mean, it is, right?
Right. Keep going.
Sitting next to someone who just got back from Brazil. Continue, please.
I don't think that is the only, it's very exciting, but at the same time, recognizing that just because something is a very hot IPO doesn't mean that in the 1 or 3 months that the returns are, always as incredible as the trading on the first day. So diversification, having transparency, and making sure you understand what your index hold is what we're trying to educate our clients about.
Torsten Slok of Apollo put out a note this morning saying tech dominance is pushing single stock risk to records. I mean, how many people realize that when they buy a NASDAQ ETF, they're getting a whole lot of space and they're getting not necessarily some sort of allocation to the U.S. economy? Given that, how much do U.S. economic metrics matter to the vast majority of equity investments right now in the U.S.?
I mean, they do matter, obviously. We recognize that when we see earnings growth come through in the first quarter. Obviously, we wouldn't. Yes, a lot of that is extremely secular and related to AI or energy. We know that. But even outside of that, if we looked at Q1 versus Q1 of 2025, having 8 of the 11 sectors having such strong earnings growth and seeing some signs of broadening out, not in performance, but in earnings, is related to this really solid nominal GDP environment that we're in. And I think it does matter. Having said that, right now, the themes that we're talking to clients about and that we're writing around are the 2 durable growers, which is AI and which is energy security. And then the other one is focusing on income. And that's what clients want.
You sound so optimistic. Are clients worried right now?
Honestly, clients are, we do these polling insights that we get from clients, and what we've seen is there was a large worry, there was a dip in client sentiment right around April, and that's picked back up to where we were in the January period. So risk sentiment from our clients are not exhibiting huge amounts of worry. Even if you look at ETF flows, obviously, if you look at over the last 2 months, we've seen incredible amount of inflows into both U.S. equities as well as fixed income. There is a tremendous amount of cash on the sidelines, so I would say that's another good reason for us to expect, the market to hold in okay. Having said all of that, I will caution that we are primed for pullbacks in times where we've had very rapid moves and rates move higher in a very rapid fashion. Both of those, if they happen, I think pullbacks can occur. And if they do, I think it's a healthy opportunity to buy those durable growers.
What's the bond market call? You've given us the equity call. Where's the bond market fit in? Because the big risk, people were worried about a repeat of 22.
Absolutely. So I want to be very clear that this is not a repeat of 2022. This is an environment where you have supply-driven shocks. And that's very different from 2022 when rates were at 0 and you had to move them up very quickly. I think it's more and more apparent that we're not going to get a rate cut anytime soon. And I think that's a realization that we have obviously all agreed upon. But I also don't think that we're going to hike very quickly either, because again, this is a supply-driven energy shock, and there's really no reason to believe that a rate hike is actually going to help consumers at this point of time. So bond market call, I think, 10 years probably stay around here, and you can get some really attractive entry points to clip some coupon. And we're actually seeing that in the fixed income ETF flows. Best month ever in May.
Mexico City?
Mexico City.
Nice, Four Seasons?
Chapultepec Park. Let's go running.
OK, very cool. I know it well. Gagi, thank you. Gagi Chaudhuri there of BlackRock. Equity futures right now in the S&P down by 0.9% with an update on stories worldwide with your Bloomberg brief. Vonnie Gwynn has more. Hey, Vonnie.
Hey, John. Thank you. President Donald Trump telling Fox News he's close to ordering new strikes on Iran. The warning coming after Trump posted on Truth Social Iran will, quote, pay the price for taking too long to negotiate a peace deal. Supermicro is plunging in the pre-market. The AI server maker joining the race for cash with plans to raise $7 billion through a package of equity offerings. The proceeds will be used to further fuel spending and fulfill customer orders. Game 4 of the NBA Finals between the New York Knicks and the San Antonio Spurs tipping off tonight at 8:30 Eastern. The Knicks holding a 2-1 lead in this series. Tonight's game will be played at New York's Madison Square Garden. The Knicks looking for their first championship in more than 50 years. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thanks for the update. Up next on the programme, the Morning Calls Plus, Dan Ives of Wedbush as SpaceX draws record demand ahead of its IPO. That conversation just around the corner, live from New York City this morning. Good morning.
A lot of non-fundamental factors that are going to interfere with markets and cause volatility over the summer. People need to make room in their portfolios for all the equity capital that's being raised, including SpaceX. We still sit in what is, at worst, the middle of the biggest infrastructure build-out since the railroads. If we see volatility on some of these non-fundamental factors, we're likely to buy it.
That was Steve Chevron of Federated. Constructive on this equity market with these pullbacks. We're down by 0.8 on the S&P. On the Nasdaq, we're negative close to 1.5 going into the opening bound 1 hour and 15 minutes away. That's the price action. Let's get you some morning calls. First up, Barclays raising its price target on Datadog to 260, saying its product velocity will continue to drive its leading position. Elsewhere, Bank of America upgrading ST Microelectronics to buy, saying the market is underestimating the chip maker's earnings power. And finally, BTIG boosting its target on Cloudflare to 269, saying underlying enterprise momentum remains strong, and yet still that stock is down by close to 2%. Let's talk about SpaceX, already shattering records ahead of a historic IPO, lining up over $250 billion in investor demand as its market debut fast approaches. Bloomberg's Ed Ludlow joins us now for more. Ed, what do we know ahead of this one?
Yeah, the state of play is that it is many multiple times oversubscribed, but there's actually something happening in the background, which is there is a roadshow, and the book will close for institutional investors at 4 p.m. Eastern time this evening. What we know is that the allocations are going to very heavily favour long-only asset managers, and that there are several institutional entities that have submitted orders for $10 billion worth of shares. By the way, if you are one of those institutions and you have submitted an order, and please telephone me and tell me what's going on. But this is interesting because SpaceX kind of pre-priced its IPO at $135 ahead of the roadshow. There wasn't some sort of traditional range. And the question as it relates to the rest of the year, when we have an Anthropic and potentially also an OpenAI IPO, is what is the story that's being told by the bankers and SpaceX to potential investors in the interim? Yes, they're oversubscribed, which would justify the initial valuation. And our reporting suggests that actually there's a big focus on this data center in space story. SpaceX telling the pool that basically whatever was in the prospectus, they could start doing orbital tests sooner. Maybe 2027, maybe 2028. So there's a lot to happen in the next 48 hours mechanically. But one thing I think is really important for the surveillance audience is take a look at the rest of the month of June. There will be a big, passive issue with the rapid inclusion into the Nasdaq Russell 1000. But also, there's a lot that can drive volatility and as a catalyst in this market. So buckle in, John.
Looking forward to your coverage, Ed. It's great to have you here in New York, and Ludlow, covering that story over the next several days. I'm always a little bit wary of numbers about things being oversubscribed? Because this is one of those instances, just like the debt market that you've covered for years, Bramo, where you ask for more than you think you'll actually get, just to make sure that you get some.
People are trying to front run the index inclusion also. Just keep that in mind. A lot of this is baking in the inherent demand that comes from the rapid inclusion in the NASDAQ and other indexes. And so at a certain point, does this indicate desire for SpaceX or desire for a trade that doesn't really indicate longer term demand?
Dan Ives of Wedbush writes in the following: while there will be some worries that the mammoth SpaceX will take away some oxygen from the tech semi-trade, this will be a short-term bump in the road. Dan joins us now for more. Dan, good morning.
Great to be here.
The appetite for this IPO. I think Lisa makes a fantastic point. A lot of people are talking about the same thing, just trying to get ahead of the index inclusion, aren't they?
No, look, I think that's definitely a play. And I think to say it's not would be wrong because of just the unique situation here from the indexing coming out of the gates. But look, at the end of the day, it does come down to it's viewed as a derivative of the AI revolution in terms of like how you're going to play space, data, AI. And look, it's a test for the market in terms of not just SpaceX, but the ripple effect across the rest of tech. And I think that's what you're seeing. You're starting last week in terms of the sell-off that we've seen in semis. I think it's playing into just, it's a little white knuckle moment that we're going through in tech, just to see how this is the reception ultimately is going to be.
But it's not just this. It's pushback to equity capital raises elsewhere. The report of maybe Meta doing the same thing. We've had another player this morning suggest they're going to do the same thing, pushback in the equity market. Do we have the space for these names?
Look, I believe you do. And I think even if you look like Google after they did the offering, the view that you were going to have a big sell-off, but instead I think actually took it, pretty well in terms of the stock. Look, it's $4 trillion that's going to be spent over the coming years. This is an arms race playing out. I don't care whether it's SpaceX, Anthropic, OpenAI, in terms of the capital raise that we're seeing. And I think these companies understand the demand's there. The difference is if we go back 6 months ago, it's like, show the monetization. Is CapEx going to accelerate? It's happening. And I think now that there's more of a green light, I think that just gives further confidence. I think investors now are able to see around the corner because we just saw like this weekend, like our Taiwan checks, like further just tighter supply, which is just more bullish for chips, more bullish for what we see, across semis and obviously across memory.
That said, I mean, a lot of people can buy into the story and say this truly is a revolution, but say that the pricing is already pretty full, especially because as the supply becomes constrained, people are paying more and more for it, and they're raising debt that they have to pay back later with future revenues that go to that. At what point do you see that as having a viable argument?
Yeah, look, it all comes down to like monetization on the use cases, not just on the enterprise, but on the consumer side. Because, look, you build it, will they come? So now it's all built. You see the demand there, but now it comes down to the next phase, and you got to see in earnings. The big reason we saw the rally that we have, it goes back to like obviously the negative sentiment in March, but then if you go through earnings in April and May, I mean those were, I think Jalen Brunson in terms of what we saw in terms of numbers. Now it comes down to it's setting up for what I believe is going to be earnings over the coming quarters that will further support tech stocks. We continue to think NASDAQ 30,000 in the next 6 months.
You talk about the consumer-facing side. You have to see it there. Does that mean that you like Chinese tech stocks better than the U.S. that's catering more to corporate?
Look, but it's also why, like in Cupertino, what Apple's doing now, the start of at least having an adequate AI strategy, because on the consumer side, it will come and go through Apple. I continue to view them as a toll collector on the AI highway. But look, in China, robotics is where they're winning. And I think you cannot just view this market. It's not just the U.S. China, there's going to be a lot of winners, and we continue to view Alibaba, some others in terms of big tech in China, where that continues to really be, I think, just starting the next phase.
Dan, speaking of China, what do you make of the U.S. looking at potentially nationalizing parts of these companies, similar to what China does?
Look, it's his balancing act, and I think it speaks to, like, you're not going to see any sort of, like, what I'd be like nationalization, because the reality there is that it further, I think, stumps from a regulatory perspective. But
wait, you do think we're going to see this or not?
I don't. So I don't think in the U.S. you're going to see national, but I do think you will see stakes, just like Intel.
Well, how's that not nationalization?
Look, I think that's, the problem is that a big part of where Intel is today, it's because of the investment that you saw from Trump administration. then it comes down to like, was that the right move? I'd argue in that situation, I think it was the right move because you can't have Intel basically being a blockbuster video of tech. But I think selectively they're going to take stakes in different companies because look, it is true. Like in what's happening in China, that is an arms
let's talk about what we're buying. What happens to demand for the products that OpenAI and Anthropic are distributing right now when they start charging what it actually costs? What happens to demand, and what are we seeing already happen in C-suites around this country?
Look, I think you're gonna have to see the cost of tokenization continue to go down. You will see limits in terms of what we see on caps in some companies, but I think it also going to come down to like as companies monetize that, and as they know that those dollars are being spent for revenue that's accelerating within these companies. That's where all of a sudden the two charts start to cross.
Where do you see revenue acceleration because of AI adoption? Where do you see that right now?
Well, I think it's already started happening in the data layer. I mean, if you look at Snowflake, you look at Datadog, you look at Innodata. So it just started off, it was just chips. Now data layer. Then it's going to be software. Oracle obviously is going to be key in terms of what we see from them. Hyperscalers, I continue to think, are not being factored in terms of the true monetization, like a Microsoft being
Which ones?
a good example.
Microsoft and who else?
Look, I think if I look at go back to like what's happened in Google, and a year ago, New York City cab drivers bearish in Alphabet. Now, what they're monetizing on hyperscaler, on search, on Gemini, narratives are very easy where there was change, and I continue to think this is third inning, one out.
Okay.
Relative to the AI game.
You're more confident on that NASDAQ call or the Knicks going into game 4?
Well, I think Knicks game 4, but ultimately I do think Knicks in 5, NASDAQ 30,000.
So they win in San Antonio. They win in Texas?
I think they win in San Antonio.
Okay.
Maybe we should go.
Are you going?
We never know.
Okay. Considering it?
Considering it.
Okay. Dan out of Wedbush. Dan, thank you, buddy. It's good to see you. Massive event taking place later this week. A mega record-breaking IPO from SpaceX.
I thought you were going to talk about the next game. I wasn't sure where you were going to go with that.
Same.
The key is, and I think the monetization point's a really interesting one. The areas that have monetized this the best are the ones that are starting to see some of the job justification as well. I'm talking about the financial sector, the software sector, data center, programming centers. That's the forward edge. So how much does monetization come at the expense of other areas?
Futures right now, negative 0.8%. Up next on the program, inflation data in America. We're looking for a 4 handle on CPI, something we haven't seen in 3 years. Tiffany Wilding of Pimco is here to react. That conversation just around the corner. Inflation data just seconds away. Going into it, equity futures declining. Tech jitters return. We're down by 0.75% on the S&P. On the Nasdaq, we're down by 1.2% in the bond market. Twos just off the highs of the year. We're up a single basis point, 4.13 on a 2-year yield. On 10s, up around a single basis point to 4.52. We're looking for a 4 handle on CPI this morning with the economic data. Mike McKee has more. Good morning, Mike.
Good morning, John. And we have a 4 handle. 4.2% is the inflation rate for the last 12 months in the headline CPI. That's exactly what was anticipated. The month over month for the headline is up 0.5% as anticipated. For the core, it is a 0.2 gain. And for the year over year number, it is 2.9%. So the economist survey is bang on what was expected for the total month. Now, we can look at the numbers overall and see that for goods and services, now this is the kind of breakdown the Fed's going to be looking at. Goods prices were down 0.1% if you take out food and energy, and service prices were up 0.3%. I'll look for additional breakdowns of where the price action is, and I guess I'm guessing I'm seeing on the screen, John, that we're having maybe a little more market reaction to an exact hit for economists than I might have expected.
Mike, sometimes a meet is a beat. It's better than expected.
Yeah.
We had some very hawkish expectations going into next week. I can tell you that core CPI month over month, it was a very small downside surprise, but a downside surprise nevertheless. It came in at 0.2% against an estimate in our survey of 0.3. If you take this and push it into the market, to Mike's point, you do see a spike in equities just off the lows on the the S&P 500, on the Nasdaq, on the Russell this morning. Equities shaping up as follows. On the S&P 500, down just 0.7%. It was down a little bit more than that going into the print. If we turn to the bond market now and check out yields, yields were pushing just a little bit higher at the front end of the curve by a few basis points earlier on this morning. Now just about unchanged at 412.24. So inflation not as hot as expected, looking at core CPI month over month, in line with expectations basically everywhere else going into this meeting a week today at the Federal Reserve.
It took off the worst case scenario, which was an upside beat that would really raise the heat for the Federal Reserve. And also, I will point out something else that people have mentioned is that earnings are not keeping pace, at least the earnings of individuals. Maybe the earnings of companies are, but not the earnings of individuals. That declined 0.7% when you take a look at the real metric in this latest reading versus negative 0.3% in the previous one. So with respect to spending power, this does diminish the spending power based on wages and the wage gain that's not exactly keeping pace with inflation.
Mike, we'll give you a second and third look. Give us a second look at this data this morning. Where's the little pop coming from? Is it more than just energy?
It doesn't look like it's a whole lot more than just energy. We saw gasoline prices up by 0.7%, and that is a significant, by 7%. Which makes more sense. And that's up from last month. So we're seeing a big increase in gasoline prices. But most everything else is up slightly, not up a huge amount. I'll continue looking through this, but things like apparel up 0.3, very similar to last month. Medical care services were up 0.5%. Now, that's a big move up. So that's something to keep an eye on. It was flat the month before, but we'll keep looking through the rest of this. I can tell you very quickly that used cars and trucks contributed absolutely nothing to this. Remember when we used to watch them very closely?
I do.
No big deal from them.
We'll come back to you, Mike, in just a moment. Brahma, what do you see?
One interesting note is that rent of primary residence has ticked up just a bit. So you actually do see in this the idea that maybe people are paying a little bit more for some of the areas that have been disinflationary, which is notable. Other than that, I mean, the other issue is electricity. The fact that it still is rising at about 6%, 5.9% clip. I mean, this is going to become a political issue, but it's, yes, this is a story about oil prices, but this is also very much a story about artificial intelligence and data centers.
Without a doubt. Joining us now to discuss, Tiffany Wilding of Pimco. Tiffany, welcome to the programme. 4 handle on inflation, widely anticipated. Haven't seen that for 3 years. Tiffany, can this Fed look through this?
Yeah, I think the key question right now is, is inflation elevated as a result of negative supply shocks or a positive demand in the economy that's lifting inflation? And clearly what you're seeing from the headline story when the higher energy prices is that is being driven by, the negative supply shocks that we're seeing coming out of the Middle East and high gasoline prices as a result. Now if we look at core, I think that, there's more of a question there. And I think that's why you're starting to see some Fed officials that are talking about interest rate hikes. But at the same time, we know that we've had some pass through of tariff, higher costs as a result of tariffs. And you have the AI story as well, which has been bleeding over into inflation a bit. So there's some supply shocks on that side as well, or kind of one-off things. And we think outside of that, core inflation in the U.S. still looks like, it's on a trajectory that, that eventually should be okay for the Fed. Now, again, we'll get some of the energy that is bleeding into the core, airfares elevated, and things like that. But ultimately, we do think they have room here to look through and wait and see how this plays out.
Tiffany, we've heard that for 5 years. And inflation has been above target for 5 years. And the incoming Fed chair, in his own words, said inflation is a choice. Do they need to do something here just to anchor credibility?
Yeah, so as of right now, if you look at a range of estimates for inflation expectations, they look pretty well anchored. The markets certainly are giving the Fed a lot of credibility. And if you look across the surveys, we would argue the surveys, look pretty well anchored as well. Of course, 1 year inflation expectations from various surveys have gone up, but they always sort of tend to lag inflationary pressures. So I think the Fed has some room here to take a look and see what's going on. The other thing about negative supply shocks is, it's a more difficult or tricky choice in terms of the dual mandate. So although it's putting upward pressure on inflation, it's putting downward pressure on activity, potentially some upward pressure on the unemployment rate. So they're going to absolutely weigh that piece of this as well. We do think at the next FOMC meeting that they will drop the forward guidance most likely. There was, this so-called easing bias in the language in the statement. If you sort of squinted, maybe you could see that. And it's a nuance we think they probably will drop just to signal, that there are more two-sided risks here. But at the end of the day, we think the Fed is going to be careful, not to overreact to what could be supply shocks that are pushing up inflation and could be temporary.
Tiffany, when did they move their target to 3% rather than 2%?
Well, certainly that will be a question for the new Fed chair, Warsh, when he gets in there. As we heard from Powell, he said that he was not going to change the inflation target during his tenure. They just had a review of their long-term strategy that they discussed last fall, and in that longer-term review, they sort of moved the asymmetric language in terms of how they're thinking about inflation out. So now you're kind of back to just an inflation targeting, flexible inflation targeting central bank type of strategy. So all of that sort of signals to us that they're not going to move their inflation target of 2% officially. Now having said that, though, in terms of Fed strategy, we can kind of think of it like the 90s strategy, the opportunistic disinflation strategy, where we've had a series of supply shocks that keeps inflation slightly above target, and the Fed sort of knows at some point we could fall into recession. We all hope that we don't, but in that case we'll have below target inflation, and so they don't really want to overreact to get inflation to target now, just given the cost of higher unemployment that could result. So some tolerance for above target inflation for a little bit, knowing that at some point you probably will, get some of those recessionary forces that bring it below.
I don't envy the Fed right now, Tiffany. I mean, there are all these geopolitical choke points that are creating a series of sequential supply-side shocks that, on one hand, you could say they want to look through. On the other hand, there is a secular overlay of what we're seeing with artificial intelligence, this incredible demand for assets of all types, and that seems to be price inelastic. I'm just wondering, from your vantage point, how you view that in the inflation story. Should that be concerning, given the fact that electricity is rising at about 6% year over year when it comes to just the inflationary pressures?
Yeah, I mean, so I think that's the tricky thing as well, right? I mean, there is certainly a piece of this that is demand related. And again, the Federal Reserve monetary policy more generally, has more of an ability to impact demand. And they also want to try to understand, how persistent is this demand impulse going to be? And certainly the AI demand impulse is absolutely there. And we've seen it accelerate at the beginning of this year, coinciding with the Iran events. So I think that's certainly something they're going to weigh. And we're seeing the prices of components related to the infrastructure build out really skyrocket. And that is spilling over into the price components of those, into the consumer price components in those categories. That's impacting PCE more than CPI, not to get too wonky, but the PCE is their preferred measure. Yeah, I mean, so there's definitely, some demand-driven inflationary pressures here, but we've been talking about this two-speed economy for quite some time, and there's certainly another part of the economy outside of AI, and maybe outside of the top 20% of households that hold a lot of their wealth in stocks, that isn't doing as well as a result of these economic fundamentals. So, the labor market, for example, does not look like a source of inflationary pressures at the moment. So the Fed has to weigh all of these factors. And again, what monetary policy theory would suggest when there's a lot of uncertainty is you go slow and you wait and see. And again, we think as of right now, that means they are on hold for the next little bit.
Tiffany, appreciate your time. As always, it's good to see you. Tiffany Wilding there of Pimco, reacting to the latest inflation data. I remember Governor King of the Bank of England looking through inflation coming out of GFC. There was a decent argument for it. I understood it at the time. These shocks keep coming. And we've now had inflation above target 4 or 5 years. Maybe this argument was a little bit more comfortable to make when inflation was around 2.5%, maybe pushing 3, but through 4, I'd say it's increasingly getting more uncomfortable for this Federal Reserve.
When we were coming out of the financial crisis, we didn't have volatility in inflation. It was either going up or it was going down. It wasn't going up and down and up and down and up and down. And how does the Fed deal with volatility and inflation with consumers that are primed to prices that aren't exactly fixed and that have been moving around quite a bit?
Mike the Key still tracking the data. I promised Mike a third look. This is the third look. Mike, what do you see?
Third update here. As I mentioned, goods and services. Goods prices are flat for the month. Service prices up 0.3. And then we look at some of the categories here. Gasoline was up, as I said, 7%. That was a big one. And apparel up by just 0.3%. Rent of shelter up by 0.4, but OER up by 0.3. It was 5 the month before, so that's less of a drag on inflation. Airline fares 2.7%. That's one of the bigger ones that moved. But here's another one that's kind of interesting. Last month, tomato prices were up 15.1%. This month, they fell by 6.1%. We're seeing some give back to some categories that we saw in the last big report, and it is kind of interesting to see. Same thing happening with computers and software, up 0.2%. They were up 5% the month before. So some of the changes here are suggesting maybe a kind of change in pattern that we're going to get. But one thing that will worry the Fed, bottom line, is you look at a 3-month annualized rate and we're at 8%, up from 7%. So inflation's still overall going in the wrong direction.
Mike, thank you, buddy. It's interesting you get a bigger bounce in the equity market than you do in the bond market off the back of this. Two's just about unchanged on the session. They were higher by a few basis points. Check out the equity market, taking out about half the losses this morning. We're still down 0.4%.
The risk scenario for a lot of people is if the Fed does start to be hostile to the equity market. That's the phrasing that we've gotten from people. If they signal a rate hike, that could curtail some of the enthusiasm, curb the enthusiasm in markets, and that is not what they want to see.
It's hard to put pressure on this institution to reduce interest rates with inflation at 4%, which speaks to why the Treasury Secretary more recently has given the incoming Fed chair a little bit of space. How much space the President will be willing to give Kevin Warsh in the next few months? It's going to be an interesting summer.
I'm not sure, because when we said to the President over the weekend, well, the market is pricing in a hike, he pretty much was like, well, I want to see a cut. And that was it. And maybe he's going to let Kevin Warsh, his pick, have a little bit more of an easy ride his first meeting or two, but then potentially it might become challenging, especially if you have more rhetoric from individuals on the Fed saying that they want to stamp out inflation.
We should do pay-per-view next Wednesday, box office. Kevin Warsh just around the corner. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, recapping the inflation data we just got. May CPI data meeting Bloomberg survey estimates. The headline number jumping 4.2% year over year. It's the first time CPI has crossed 4% in 3 years as the war in Iran continues to weigh on fuel and food costs. President Donald Trump out with a new warning for Iran, telling Fox he's close to ordering new strikes. The president posting on Truth Social, Iran paid the price for taking too long to negotiate a peace deal. Global investors awaiting Friday's historic SpaceX IPO. Gulf wealth funds are putting in orders for shares worth several billions of dollars in the IPO, we're told. Saudi Arabia's Public Investment Fund and the Kuwait Investment Authority have each placed orders for shares worth between $1 billion and $5 billion. And that's your Bloomberg brief. John.
Vonnie, thank you. That's a bit of a flex. Things are tight at the moment in that region. I think that's a bit of a flex going into this IPO.
Yeah, I think what they're saying is they're tighter, but they're not that tight. We're still able to make sure we can get in on massive opportunities, even though we're dealing with the conflict in the region.
Up next on the programme, we'll catch up with David Kelly of JPMorgan Asset Management on the risk markets may be overlooking. Plus, Yahaira has your morning movers. Freight stocks falling as Amazon expands its own shipping service. That story is just around the corner.
Clearly what you're seeing from the headline story, that is being driven by, the negative supply shocks that we're seeing coming out of the Middle East. Core inflation in the U.S. still looks like, it's on a trajectory that, that eventually should be okay for the Fed. We do think they have room here to look through and wait and see how this plays out.
Tiffany Wilding, Pimco, headline inflation 4.2% as expected, the highest in some 3 years. Haven't seen a 4 handle since 2023. Core CPI, month over month, just a touch softer than expected, in at 0.2%. The survey, our survey, the median estimate 0.3%. With that, equities are raising losses going into the opening bell. About 41 minutes away. Equity futures negative just 0.4% on the S&P. On the Nasdaq, we're down by 0.65. Let's get you some morning movers, some single names. Yahara has more. Hey, Yahara.
Hi, John. We are seeing the freight stocks under pressure. An announcement from Amazon that is expanding its less than truckload shipping business to all customers, not just those shipping Amazon products. So you're seeing names like Saia, FedEx Freight, and Old Dominion all falling in the pre-market, since this puts Amazon in more direct competition with them and highlights its growing presence in the freight market. Meanwhile, we're also seeing Super Micro shares falling some 12% in the pre-market as it joins the party to raise capital, announcing a $7 billion equity raise. The company's sales for the company's AI servers have surged, but that just means it needs more money, about $39 billion worth, in order to fulfill customer orders. And we end on the next big test for the AI trade, which is Oracle. It is trimming its earlier losses, now just down 1.5%. And looking through analyst notes, the big focus will be on whether Oracle is building data centers fast enough and converting those AI bookings into actual revenue at a time we know demand is through the roof. John?
Yahara, thank you. Looking forward to that report a little bit later. Joining us around the table following that inflation data, David Kelly of JPMorgan Asset Management. David, good morning.
Glad to be here.
How uncomfortable are things for this Federal Reserve next week?
Somewhat uncomfortable, but I think essentially we're going to get a 12-0 vote to do nothing. The safest thing the Federal Reserve can do politically and also economically, I think, is just to do nothing here. Inflation is higher than they want, but I think there's a good chance that this month, May, will actually turn out to be the high watermark for inflation in this cycle. We have seen gasoline prices come down pretty significantly in June. I think June will see a lower year-over-year rate, and if we come to some settlement which allows oil to come out of the Strait of Hormuz, then inflation will gradually drift down. So it's not nice seeing a four handle. There certainly is no excuse for easing at this point, but I think the Fed can sit pat.
How much of it is out of their control at the moment?
Oh, it's completely out of their control. Well, first of all, they don't really control inflation that much with interest rates anyway. I mean, let's be honest about this. We've seen nothing in the last, honestly, few decades which suggests the Federal Reserve can actually speed up economic growth by cutting rates or slow economic growth by raising them. There's very little evidence that even works. And in this case, it's about energy.
Does the new chairman agree with you?
We'll see. I think he's a very intelligent guy, and I think there was a certain amount of complexity in some of his answers to questions on inflation. I don't think he has any intention of leading a charge to cut interest rates when you've got the inflation rate basically at the unemployment rate target. I mean, their target is supposed to be 4.2% on the unemployment rate. We're 4.2% on inflation. That's double, almost, even in PCE terms, it's essentially double where they want to be.
The one thing that the Fed does have some influence over is financial conditions.
Yes.
And this is the reason why maybe you're seeing a stock market rally a bit more, respond more to this print than the bond market. At what point do they have to take that into consideration, given the amount of debt and equity being raised right now?
Well, again, there's very little. The problem is that yes, raising interest rates sharply would perhaps calm down some of the speculation and maybe cause a correction in markets, which might actually be a healthy thing. But it's such a, it's taking a sledgehammer to a fly. I mean, they will do a lot of economic damage if they do that also. And so they have to, I think they should be worried about too much speculation. I don't think there's much they can do about it.
Sledgehammer to a fly. That said, some people are saying that you have companies raising more and more money to pay for prices that are going up and up and up. At what point is that directly fueling inflation in the areas that the Fed doesn't ostensibly have control over, but comes with the enthusiasm in capital markets? Well,
the inflation the Federal Reserve should honestly worry about is inflation in things like food, clothing, energy, the basics. I mean, if the cost of compute goes up, I mean, that's not great if you're a big tech company, but it doesn't really affect the average person that much. So I think they've got to look at broader inflation. There's not much they can do about it. It really is much more over on the other side of Washington that these decisions are being made. Now, there are things the federal government ought to do to try and calm speculation in financial markets, perhaps, both in terms of AI regulation, crypto regulation. There are things they can do, but I don't think there's very much the Federal Reserve can do right now to calm this down.
David, if you think this is the peak, that's predicated on you think there's going to be a deal. Because we're getting to levels that are very low on inventories and tanks.
That's right.
So most people actually are saying in the commodity market, if there's no deal, prices could surge from here.
That is our biggest concern. The biggest concern is that people will take some sort of comfort in the fact that gasoline prices have come down in the last few weeks, because that's because of a massive release of inventory, including from the Strategic Petroleum Reserve, which is down 60 million barrels in the space of a few months. We can't do this forever. And I hope the administration is not taking a signal from the lack of gasoline inflation that this is somehow an equilibrium. It's not, and you're quite right. But eventually, if gasoline prices started going up again, we were moving closer and closer to the midterm elections. I expect that the issue of nuclear and the issue of Hormuz will be separated. And once that happens, and you actually negotiate honestly about trying to get stuff in and out of Hormuz, then a deal will be made.
Massive helping hand from China too, importing less. SocGen wrote about this early this week. The refiners reducing demand as well. That's really helped this energy market.
But it's not like they didn't stop moving. It's obviously an inventory draw.
Oh, no, without a doubt. That's what I'm getting at.
And again, because
these are all these offsets that have made this a lot less worse.
The point is, the world uses 100 million barrels of oil a day. You can't take 20 million barrels out of that equation and expect it to be equilibrium. Oil is an unusual commodity in that we have massive quantities of inventory. Everybody's had a strategic petroleum reserve. So we could actually take this hit for a number of months because people realize its vulnerability. But that gets you a month, 2 months, 3 months. It doesn't get you 6 months. It doesn't get you a year. And so at some stage, a solution has to be found.
David, it's good to see you. It always is. Thank you, buddy. David Kelly there of JPMorgan Asset Management. Inflation with a full handle.
Yeah, let's just put that in perspective. This is the hottest headline read going back to 2023. Inflation moving in the wrong direction for the Federal Reserve.
Uncomfortable for the new Fed chair. Coming up tomorrow, Julian Emmanuel of Evercore, Francis Donald of RBC, Savita Subramaniam. She says there's red flags out there. Take profit. She joins us from Bank of America tomorrow alongside Neela Richardson of ADP. From New York City this morning, good morning. This was Bloomberg Surveillance.